Apple or whatever stock you're trading is yours. But there is a time limit that's attached to it. So you got to figure out that expiration date that you want. And you can pick these dates. All right. Then you have to pick a strike price. We'll talk about that later. And then you want to calculate the break even, which I call the worst case scenario. Okay. Now I'm going to show you guys a video. All right. When you watch this video, it is not going to answer 100% of the questions that you have about the options world. I just want you guys to see a live options video, and about maybe 30% of the questions that you have about options will be answered. But I understand that they're not going to be answered, not 100%. So I want you to focus on the video, just watch it, and then let me continue teaching. And then as questions come up, you can ask those questions in the chat room. And then what I'm gonna do is I'm gonna take those questions. Well, my niece who's working with me today, she's gonna bring me those questions down, and at the halfway point, I'm gonna answer those questions for you guys. And then we're gonna do the second part of the session, all right, where we get into strategy. All right, I'm gonna explain to you what options are in the first half. The second half, we're gonna get into strategy. All right, so when we get into strategy, you guys can compile another list of questions. I'm also going to do a charts with Joel at the end of the session. What does that mean? That means at the end of the session, everybody that's on today, just to show you that I know what I'm doing, I'm gonna allow each of you to give me one stock, and I'm gonna analyze your stock on whatever time frame you want with my tools, and we're gonna all look at that stock together to figure out how to buy it, where to buy it, if it's bullish, if it's bearish, using my tools. And that's called Charts with Joel. I usually do it once a week in one of my rooms, so a lot of you guys are already familiar with how it works. So let's watch this particular video. And this is on the Robinhood platform. Hello, traders. It's March the 16th. It's a bloody Monday. And the Dow and the S&P 500 are down over 7% this morning. So I wanted to show you guys how to buy options. All right, I'm going to take a quick trade. I think we might get a little pop in the next couple of days. And with options, I can get more bang from my buck. So I want to show you guys how to place a call option on one of the ETFs. So once you open up your Robinhood account, you definitely have to set up your options account. And once you set up your options account, you should be able to buy options on your computer, your desktop, or your phone. This is the desktop that we're looking at right now. So once you find the stock that you want to buy the option on, we're going to look at the SPDRs ETF. And once you pull up the SPDRs ETF, if you notice to your right, you can buy the SPDRs in stock. As you can see, it will cost you $250 a share, but I'm going to try an option. All right. Now, remember, when you're buying options, for every option that you buy, it's controlling 100 shares. So that's the beauty of buying options using the leverage. Okay. So if you noticed, what I like to do is I usually like to go about, if I'm looking for a quick pop, I want to go about 5 days out. This is expiring March the 16th, which is today. So we don't want to take that option. We want to take an option that's a little bit further out. So we're going to go to maybe the 20th or maybe the week after that. So you click on the expiration date. We're going to go to the 20th, which is the end of the week. Because I'm only looking for, a 1 day or a 2 day pop. And once those options show up, we want to pick a strike price. So we see that the share price is $250. So I kind of like to buy at the money. So I'm going to choose the one that's the cheapest. All right. So we have a strike price here at $251 and $250. So I'm going to go ahead and go with this particular option here. Now, remember, you're controlling 100 shares. So to get, to understand how much this option would cost, it's 100 times this number. So just take a decimal point over 2 times. So this option would cost me $1,200. This would cost me $1,257. Now, options do get a little bit pricey when there's a lot of volatility. So we're going to go over here and continue. We've already picked the option that we wanted. We want to buy one contract. So we're going to place one contract there. And we're going to do a limit price. So we see that it's $11.85. So we're just going to see if we can get it for $1,200 even. So we're going to put a $12 limit price. We hit review order. You see that I have $3,000 available, so we have more than enough money to buy it. So we're buying one option, which is controlling 100 shares at $12. As you can see, it already popped $36 while we were sitting here watching it. So we're going to review the order. Once we review the order and submit, you're paying $1,200 for the right to buy 100 shares. And as you can see, it's done. And all we have to do now is just wait and see if that option takes. All right. And that's how you place an option order. Remember, we were buying a call. We're only teaching you guys calls and puts. We're buying a call because we're betting on the market going up in price, or this option going up in price, or we're betting on a put, which is betting on this price going down. And as you can see, just while we were watching it, the option went from 12, 20, all the way down to 11.98. So I'm pretty sure that our option took. So we're sitting in it right now at $1,200. Every time you see that move, that's $12 made, $22 made. I can sell this option right now and make $22. Okay, $25. All right. So that's how you buy an option. Thank you. Thank you. I'm so polite. All right, this is selling a call option. Traders, we bought a call option about 10 minutes ago, and I'm going to show you guys how to close that particular position. So as you can see here, we have the spider call that we just bought. All right, so you click on that option from your desktop. This is the desktop. You can buy it or sell it on your phone or your desktop. We're going to use the desktop. And if you notice, we're in the spider call. We used $1,200 and we're up, I think, $80 right now. We're up 6%. So if you want to get out of that option, you go to close position. We want to close one contract. And we want the limit price to be, if I want to get out right now, let's make the limit price like maybe $12.70. As soon as you review your order, we're closing our one contract position. Now we're at $12.50. So let's try to get out quickly. So let's just go to $12.30. We review the order. We submit. And bam, done. We just sold one contract for $1,230. In 10 minutes, I just made $30 buying an option contract. I didn't have to wait until the expiration date. I bought, this is the history. 8 minutes ago, I bought one call option. I used $1,200. I made $30 in about 8 minutes. And that's how you close a call option position using the Robinhood platform. All right. So why are we buying options? Well, it's easy. So we can make a whole bunch of money. I know you guys see me in the room and I'm like, I made 300% today or 500% today. And some people are like, yeah, Joel, if you made 500% and you could do it like this every other day, why isn't everybody doing it? And I tell everybody it's because you're not educated on the market, because the options market, there are these types of returns on reputable companies every single solitary day. Now, it's not going to be the same stock, but you got to know what to look for. You got to see companies that are bullish. And that's why a lot of you guys are having issues with the market, because you've been trading fundamentally your whole life. And that's fine. But in the last 20 years, the market has become really, really technical. So now in order to perform consistently in the market, you're going to need to know the fundamentals and the technicals. And a lot of people have not been educated on the technical side. I'm going to show you guys both today. But look, Snapchat on a regular day, and this is the Robinhood platform. All right, Snapchat on a regular day that might be up 3%. If you had bought the options 24 hours ago, the stock would be up 3%. The options are up 30, 20, 44%, 60% in one day. All right, that's a 1 day move, a 24-hour move. Sometimes it takes stocks a whole year to go up 60%, sometimes 2 years. You can get these types of returns every single day if you know what companies to look for. Moderna. Why is Moderna popular? Because it's one of those coronavirus stocks that has a vaccine that's out there. The stock might be up 5%, and that's significant. You know, if you had a $100,000 account, you would be up $5,800 in 1 day. But imagine, instead of being up $5,800, you put up $2,500, right? And you're up $2,500 in 1 day. All right. These are the types of returns you see every single day in the options market. Okay. Canopy Growth. Why is Canopy Growth a popular company? Because for one, it's the largest cannabis company on the planet that's publicly traded. Okay. A lot of people don't know that. All right. I think Constellation Brands has a 30% stake in the particular company. All right. Those are the makers of Corona beer. Well, the stock might be up 4%. That's not breaking the bank for most of you guys. Some of you guys' portfolios and IRAs only go up 4% in 1 year. The stock was up 4%, which is significant. The options are up 150%. Okay. Now, there is no direct correlation from the percent and this number here and this number. All right. It depends on demand and all this other stuff that we're going to talk about later. All right. But you can get those types of gains every single day. Zoom, we're on a Zoom call right now. All right. Zoom, the stock was up 5%. The options were up 200%. Now, most people know that I love my Peloton. I've been running on it like for the past 60 days, right? So I made a lot of money on the stock. But look at what the options are doing, 200%. That means if I had put up if I had bought $100 worth of Peloton yesterday, and I woke up the next morning, it could have been worth $300 the next day. That's the beauty of the options market. Now, I hate the airline companies. Everybody knows this. Now, I love Delta Airlines because my dad worked there for like 30 years, right? But I hate the stock, and I've hated the stocks for the last, couple of years. But you know what? The stock was up 9%. Look how much the options were up, 600, 500. Even the lowest options were like 100%, a double in your money in 1 day. 5 times your money, 6 times your money in 1 day. All right. And these are not flukes, people. This is what, when you learn how to buy stocks that are hot, you're going to see these types of gains all the time. All right. Silver. Why is silver so popular? Well, I'm going to give you guys a stock tip that you can use for the rest of your life. All right. And that's going to cost, that's the cost of this particular session. Anytime you hear that a federal government is going to print money, that's going to cause what we call inflation. And the way that we combat inflation is that investors start to invest in precious metals. Anytime you see when Obama in 2008 said, hey, the government's going to create a $800 billion bailout, you should have run out and bought as much gold and silver as you could. Well, same thing happened here. During the pandemic, the Trump organization said, well, how did Obama turn the market around? Well, they had a bailout, or they put funding out into they printed money and helped all the businesses that were out there. So when Trump's government decided to do the same thing, silver, gold, precious metals, cryptocurrency all started to explode in price. We all knew that it was going to go up. Most people don't know this because you're not educated on how the stock market works and how the stock market and real estate and everything around you is all connected. Well, silver was up 12%. The options were up 700% in one day. That's crazy. That's how much Tesla was up in the last year that everybody's going bonkers over. And I'm like, why are y'all going so bonkers over these stock moves when we see these moves every day in the options market? We're like, okay, who cares? 100% return, 300% return, right? That doesn't impress me because I trade the options market and I trade the stock market. So why are you able to make those types of gains? Because you're controlling 100 shares. What does that mean, Joel? It's exactly what I just said. One option contract controls 100 shares of that company. All right, any company that's out there, Pfizer, Lee, Macy's, Neo, Tesla, Pfizer, Plug Power, it doesn't matter. Southwest Air, Delta Airlines, American Airlines. One contract controls 100 shares. I'm going to say that again. One option contract controls 100 shares. And you're not limited to how many shares that you can buy. However much money you have, you can afford that contract. You can buy as many contracts as you want to. And each contract is going to control 100 shares. So if I buy 10 contracts, I'm going to control 1,000 shares of that company. All right. And we're not going to know how much they are. We have to check it out first to see how much those options are, to know how much, if I buy a particular contract, how much do those 100 shares cost? Some of you guys won't understand that. So maybe this will make you understand it a little bit better. You're controlling 100 shares, but you're also renting those 100 shares. Think about this. Think about a car. Think of options kind of like a car. All right. So, in February, I went down to the Super Bowl and I rented a drop top Mustang. All right. Now that Mustang probably cost anywhere from $30,000 to $40,000. When I got down to Florida, I didn't want to purchase a $40,000 vehicle to drive for 7 days. I wanted to rent it. Okay. And by renting it, I would go to Budget or Alamo and ask them, how much will it cost to rent this $40,000 vehicle? They may say $1,000. And when I pay that $1,000, I'm going to control a $40,000 vehicle. All right. For 7 days. And while I'm driving it, with the wind blowing in my hair, no one knew that I didn't own that car, right? But it was mine for 7 days. Well, options are the same thing. You're going to rent 100 shares of that company for a certain amount of time, and it's yours until that expiration date. That's why you're able to make that much money. Because if you have 100 shares of a company and it goes up $1, you're up $100. If that company is up $10, in theory, I meant to say that in theory, if it's up $10, you're going to be up $1,000, right? And it might only cost you a little bit of money to rent those shares. That's the beauty of buying options. So let me give you an example. A Tesla share right now is around $600 a share. I got to change this. Like every time I do an options party, I got to change these numbers because it used to be like 300 and then 400 and then now it's 600, right? Because Tesla's going through the roof. But one Tesla share is $600 a share. That means you need $600 to control a share of Tesla. So if you look up and Tesla is $700 a share and you only own one share, you're only going to be up $100. But what if you were able to buy one options contract of Tesla, right? You're going to control $60,000 worth of Tesla. And believe me, it's not going to cost you $60,000. Now, it might cost you $5,000 because the more expensive a share is, the more expensive the options price is going to be. We'll talk about that later. But in theory, I just want you to understand why you're able to make so much money in the options world. Okay, you're going to be controlling a lot with a little bit of money. Okay, so think about this: for every dollar rise in the stock price, and we call that the underlying. So if you look up and you see that Apple is $100 a share, and then all of a sudden it's up to $105, and you own one contract, in theory, your option is going to be up $500. Okay. So every time you see a dollar move, you can kind of give yourself an idea on how much money you can make. So if you buy an options contract today on Apple for, let's say, $1,000, right? And then you say, I think Apple can go up $100 this week. If it goes up $100, right? If it goes up $100 and you make, you make $100 for every dollar move, 100 times 100 is what? 1,000? What is it? 10,000? All right. You can make a lot of money. I think my numbers were wrong there, but you can make a lot of money. All right. So in this particular scenario, let's think about the stock. All right. And this is a stock chart for you newbies. All right. Stock charts read from left to right. Stock charts read from left to right. All right. You're going to see the time at the bottom. You're going to see the price on the right. So we're looking at Apple right now. And you want to know that you're looking at a particular time frame. So just the fact that I see a 1 minute chart, this is probably a day trader trading. So a day trader is trading Apple and they said, hey, I want to buy Apple right around 340, 1540 is 340 in Atlanta. And let's say in 20 minutes, Apple rose from 381 to 383. Now, in the stock world, I needed $381. And when Apple rose $2, I made $2. Well, I can't really break the bank with that. But let's say I bought an options contract at 381. And then all of a sudden, 20 minutes later, Apple is up $2. Well, if every contract controls 100 shares, that means for every dollar move, I should be up $100. So I should be, in theory, up $200 on my options contract. And I can sell it before the market closes at 4 o'clock. And that's another thing that I want you guys to understand. I know you've been hearing from other people expiration dates. There's two things that I want you guys to learn today. A, you can pick a strike price. We're going to talk about that later. And the stock never even has to reach that strike price for you to profit. And B, you don't have to wait until the expiration date to get your money. You can get out of an option anytime you want to, just like you can get out of a stock anytime you want to. You do not have to wait until the expiration date to cash in. The expiration date literally is just a date set that you have to give those shares back. And they say, look, I don't care what you do up until that expiration date. I don't care what you do. I don't care how much money you make or how much money you lose. But at that last day, on that Friday at 4 o'clock, you need to give me my shares back because you don't own them. All right. So we're looking at a 1 minute chart. So a $2 move is $200. We still don't know how much that option contract would have cost you. Okay. But you can get in and out, and you don't have to. We're going to talk about strike later. You don't have to pick a price you think is going to go to. That's another thing that a lot of people don't understand. I don't have to say, I think it's going to go to 383, so I only make money if it gets there. No, that's not true. Okay. And we're going to talk about that in a second. All right. So before we even get there, and there are newbies on this call, guys, I did say that this options course is for newbies. So we're going to talk about candlesticks, all right, for the next 5 or 10 minutes. So if you already know about it, go and grab you some food or whatever you need out the cabinet. But I need to educate the newbies that are on this call. All right, so we're going to look at charts today. So just like the chart we looked at before, these are called candlesticks. Each of these candlesticks are going to represent a certain amount of time. We're going to talk about 3 time frames today. The 1 minute chart, the 1 hour chart, the 1 day chart. The 1 minute chart, the 1 hour chart, the day chart. I'm going to say that again. The 1 minute chart, the 1 hour chart, the day chart. Those are the only 3 charts we're going to talk about today. We're not going to go outside of that. Those 3 different charts are going to determine what time frame you're going to be trading on. All right. But first things first, when you're looking at that particular chart, each of those candles is going to represent a certain amount of time. The chart that we looked at before represented a minute. That means every single candle represented a minute. All right. If I see 10 candles, that's 10 minutes. If I was looking at a day chart, if I looked at 10 candles, it would represent 10 trading days. Okay. Which is 9:30 to 4 o'clock Eastern Standard Time. All right. If I was looking at futures, it would be a little bit longer. It would represent 23 hours. If I was looking at cryptocurrency, it would represent 24 hours. All right. But when you're looking at your candlesticks, you're going to see a red or a green candle, red or green. All right. You're going to see candles that are hollow. You're going to see candles that are solid. All right. The candle just represents, when you're looking at it, the body. This is what we call the body. The body is going to represent the opening price and the closing price, the opening and the closing price during that minute. So if this was a minute candle, let's say this was 9:30, it would start out as a line. And then for 60 seconds, this candle would form. You know that it's an up candle if it's a hollow candle and it's green. That means at 9:30, it opened here, but it closed at a higher price. If it's a red candle that's solid, that means at the beginning of that minute, we started here and then it dropped in price over that minute. The wick just represents how high and how low it went, okay? So in a scenario, let's say Apple opened at $100 at 9:30, and this is a minute candle. Or let's just say this is a day candle. Apple opened at the beginning of the day at 9:30 a.m. It was $100 a share. Then it dropped to $95 a share. Then it rose all the way to $125 a share by 3 o'clock, and then by 4 o'clock, it closed at $125. Well, the candlestick is going to show you that it opened here, closed here, but it went this low and this high during the day. And then the next day, another candle will form, okay? So that's how you use the candles to kind of figure out what the price action is doing at that time. Now, in the stock world, we have different terms that we use for betting on the market going up and betting on the market going down. In the stock world, if you're betting on the market going up, you're going to hear somebody say, hey, are you going long? Long means that you're betting on the market going up. Short means that you're betting on the market going down, okay? But in the options world, it's a little bit different. In the options world, if you're going long, you're going to buy calls. Calls mean that you're a bull, and a bull also represents money going up. If you've ever gone to a financial institution, most of the time, mutual funds, pension funds, their mascot is going to be a bull because they want to make sure you know that they make money. That's why when you go to New York, everybody goes and sees the bull that's in Times Square, I believe, because that bull is famous for the markets, okay? So if you're bullish on the market, you're betting on it going up. In the stock world, is going long. In the options world, you buy calls. In the stock world, if you're betting on the market going down in value, price goes down, all right? You're shorting the market, and you can short the market in stocks. You can literally bet on stocks going down in value. In the options world, you're going to buy puts. We're going to focus on buying calls mostly today because you guys are learning about the market. And then in your own time, you can practice maybe buying puts, betting on the market going down in value. Now, some people are still confused. How the heck do you make money with the market going down in value, Joel? Like, come on, that makes no sense. How can something lose value and you make money? Well, I'll explain it to you in a second. But for one, let's say that we were betting on the market going up. Calls are betting on Apple going from 381 to 383. What's the difference between 381 and 383? $2. So if you bought a call on Apple here and it rose in price, you gained $2. Let's say you bought a put on Apple and you started your put way up here at 384. At 384, you decided to buy a put. You wanted to bet on Apple going down in price. Well, what's the difference between Apple from 384 and 380? $4. So if you were betting on the market going down, you would have made $4. If you were buying a contract, you should be up about $400 in theory, okay? So puts are just betting on the prices going down. Where does that money come from? Well, money and energy are kind of similar. You know, once it's created, it's neither created nor destroyed. It's just transferred from one entity to another. All right, so energy never goes away. It's just transferred into another form. Money is the same way. People don't just lose money and then it goes poof and then they go throw that money in a fire and burn it. Remember when a lot of people lost money during the 2008 crisis? That money wasn't lost. That money was just transferred out of all of y'all's account and it went into the top 1%'s account. All right, same thing here. When somebody loses money, that means somebody that's betting the opposite way is probably, when somebody is winning on a trade, that means somebody is losing somewhere else. So the money that you're making on this short is on the people that are buying calls, betting on Apple going up in price. And that's all you really need to know. All right, so we're gonna talk about calls, and I'm gonna talk about debit spreads briefly, okay? Now, calls and puts are the most common and the easiest options to create, okay? That's what you hear people buy the most of. When you're a Robinhood, that's what probably 90% of the trades are. All right, and there are different types of options that are out there. You can learn options from now for the next 40 years. There's condors, there's straddles. We're only going to talk about calls and puts, the basics. This is a basic options class, and I'm going to teach you how to look at this, how to apply strategy. Well, the only advanced option that I'm going to teach you today is a debit spread. All right, it's just a cheaper call. Okay, and it's more difficult to create unless you're on the Thinkorswim platform that creates it for you. But if you try to create it on Robinhood, it's going to be really difficult. All right, but it's going to limit how much money that you can make. All right. I encourage you to do both. All right. And the reason why a lot of people buy this, and you'll find out later, is, let's say Tesla's options are $7,000 and you're like, I don't want to commit $7,000. Well, you can come here and buy a vertical and you might be able to find an option for $100, with a strike price and an expiration date that's right around the same time. You can use the debit spreads to limit the amount of money that you want to put into it. We'll talk about that in a second. We'll get into the meat of it. But first things first, let's talk about how to buy an option. I know you guys watched that video. Only about 20% of your questions were answered. Maybe we're about at 50% now. But first things first, you got to pick an expiration date. So this is the Thinkorswim, this is the TD Ameritrade Thinkorswim platform. This is how it's going to look. Well, first things first, you got to figure out how long you want to rent the option. Is it going to be 7 days, 14 days, 28 days? And depending on your strategy is going to determine on how long you want to trade it. Day traders want to get in and out. So they don't even care about the expiration date that's on Friday. They just want to get in and out today. So they want to go with the earliest expiration period, because they're not even going to wait till Friday. They only going to be in the trade for 20 minutes. All right. Swing traders, that are trying to make money, that's using an hour chart. They might want to do an expiration that's 10 days from now. Maybe you hear some news that's going to come out and you're trying to capitalize on the movement of that stock and you want to make money in the next 2 or 3 days. All right. So you might go 14 days out. Give yourself a little bit of time. Then you have investor options traders that go 30 days or more. And they want to make a lot of money on different stocks because they know that there's negative news. They know that there's a lot of information out there that's going to make the stock go up and down. But they believe that in, 3, 6, 9 months, that stock is going to be higher in price. All right. So depending on your strategy, you got to figure out the time frame. Well, first things first, expiration dates are usually on Friday. All right. They usually expire on Friday. Every now and then you'll see a Thursday, a Friday. Is it a holiday? And sometimes you'll see a Monday or a Tuesday, which is kind of weird to me. All right. But Friday is going to be the most common day at 4:00 p.m. Eastern Standard Time that you're going to see the expiration dates of that option. You can only have it up until that time. And all this is how long do you want to rent 100 shares of that company? And this is how it looks. You're going to see an option chain. When you see that option chain, you're going to see different dates: July 10th, July 17th, July 24th. Why are they 7 days apart? Because that's a Friday, that's the following Friday, that's the following Friday. And you're going to see a list of options that you can buy. Okay. So the expiration date is usually on a Friday, but you got to pick a date. Once you pick a date, you got to now pick a strike price. Now, I'm going to show you guys how to pick different strike prices. But for one, let's learn what strike prices are. Strike prices is just like if I wanted to rent a car, I can go to 10 different dealerships. I guess that's what they're called, or businesses. I can go to Enterprise, I can go to Alamo, I can go to Budget, I can go to Thrifty. I'm showing my age. I don't even know if those companies are around anymore. But I can go to different places and rent the same vehicle, and it might be the same vehicle, but it might be different prices. Well, that's what the strikes are. These are different places that you can rent 100 shares. And then they're going to give you the cost. They're going to say, Mr. Harrison, if you want to rent this Mustang at this dealership, it's going to cost you $455 to control 100 shares. And then this dealership is going to say, hey, if you're going to buy it at this strike, it's going to only cost you $20. And you're going to say, well, dang, wouldn't I want to rent it for $20 versus $455 or $305? Now, there is a reason for that. I'm going to explain that to you guys later. But let's talk about the at the money strike. At the money strike is literally around the same price as the stock price. So I don't even have to look at the stock price right now. We're looking at Apple, but I don't even have to look at Apple right now to know that its price right now is in between $382 and $385. It's roughly about $383 a share at this moment. How do I know that? Because when you pull up your option chain, you're going to see different colors, purple and black, on the Thinkorswim platform. That purple and black, where they meet is the at the money strike. At the money strike means this is the strike price that the stock is actually at this moment. So if you had a buddy that said, hey, I bought a at the money strike for Apple today, you're going to pull up your platform and say, well, what's your expiration date? They're going to say, oh, the expiration date is July the 10th. So you're going to say, all right, he bought a July 10th option and he bought it at the money, but I see two that are at the money. So you're going to call your buddy back and say, yo, did you buy the 382 strike or the 385? They're going to say, oh, I bought the 385 strike. You're going to say, oh, you paid about $184 for that option. They're going to say, how did you know that? And you're going to say, oh, I just pulled it up on my phone. All right. So the strike price is going to tell you how much that option is. That options cost is what we call the premium. The premium of that option, to figure out how much it costs, very easy. You just take this decimal point over 2. Just take it over 2 spaces. This option costs $1,315. This option costs $16. This option costs $58. This costs $105. What does that mean? That means I need to have $105 in my account to control 100 shares of Apple. Okay? And I have to give it back, or I have to do whatever I'm going to do, whether sell it, I have to sell it by this particular date, or I can exercise that option. We'll talk about that as well. All right. And I'm going to show you guys how to pick it. But for now, we just need to know what the strikes mean. You have at the money. You're going to hear people talk about in the money, and you're going to hear people talk about out of the money. In the money means anything that's lower than the stock price. If the stock price right now is $383, in the money is anything lower than $383. So if somebody said, I bought a deep in the money strike of Apple, they're probably buying anything in the purple. If somebody said, I just bought an out of the money strike of Apple, way out of the money, you're going to say, oh, if this is at the money, they must have bought way out here somewhere. Well, which out of the money strike did you buy? The $395 or the $400? They're going to say, oh, the $400. You're going to say, oh, you spent $6. So that's the terminology on which ones you want to buy. So now you guys know at the money, in the money, out of the money. You know the strike. These are the strikes. You know that the premium is how much it costs. You now know how much it does cost by looking at it. And these numbers change during the day. You can buy this option at 9:30 in the morning at $305. And then at the end of the day, this option might be worth $405. Can you sell it? You sure can. If this option is worth $405 at the end of the day, you just made $100. Okay? You make whatever the profit is over there. If this went up to $310, you can sell it in 3 seconds and make $5 minus your commissions. And a lot of people don't know that. Yeah, the premium goes up and down because it goes up and down with the stock. Okay? I know a lot of you guys' light bulbs are going off right now. You're like, word? I never knew that. Now, you always buy on the ask. All right. When you pull up your platform, whether it's Robinhood or TD Ameritrade, you're going to see bid and ask. You're going to see bid and ask, bid and ask. Don't buy on the bid or you're going to make an ass of yourself. All right. That's a different trade. You want to always buy on the ask. If you buy on the bid, that is selling a covered call. We're not talking about that today. We're going to talk about debit spreads, but we're not going to talk about selling covered calls. All right. You have to have 100 shares of that stock to be able to do that. So you look for the ask, and any of the asking prices is how much you can pay for that option. An option contract, remember, guys, controls 100 shares. So if you see that it's $16.70 and you got to buy 100, that option is going to cost $1,670. This is 645, 855, 1,080, 105, 32, 16, 58. Okay. So that's how you figure out how much that option is going to cost you. Now, $1 million question. All right, Joel, I just bought this for $1,080. Now what? Well, you control 100 shares. So if I come to you and I say, what strike did you buy? 372.5. Great. How much did it cost you? 1,080. That was your investment. That's your premium. So what if you look up and you see that Apple rises $2 from where you're at right now? Then you're going to be up $200. This premium is going to be worth $1,280. Joe, can I sell it? Can I sell it when I see $1,280? You sure can. You saw me do it on the video. I was in a trade for what, 8 minutes? 3 minutes, and I sold it and made $30. I bought the option for $1,200. It was up to $1,230. Anything over my premium is my profit. Anything over my premium. And you can lose that premium. We're going to talk about that later on how you can lose it. All right, so this is going to make a lot of you guys' eyes glaze over. I already know it. So let's decipher what we're looking at right now. All right, so when you pull up your TD Ameritrade platform, you're going to see an option chain come up. First of all, you have to type in Apple, and you have to pull up your options. When you pull up your options, an option chain is going to pop up. It's going to give you an expiration date. You're going to see May 22nd, May 29th, June 5th. You're going to see options go out to 2022 if you want to pay them. Now, remember, the further you go out, the more expensive an option is going to be. Just like if I was renting a Mustang for a week, if I wanted to rent it for a month, it's going to cost me more to rent that Mustang for a month than it would for a week. So naturally, in the options world, if I'm renting stock, the further you go out, the more expensive it's going to be. All right. So the premium is the ask. So first things first, you got to know what? Am I buying a call or am I buying a put? Today, we're going to concentrate on calls. We're going to buy a call today. That means we're betting on Apple going up in price. Well, we see that Apple right here is 307.71. So what does that tell you? That tells you if your buddy says, hey, I just bought Apple at the money, you're going to say, oh, he bought it somewhere around 308. How do I know that? Because that's where Apple is right now. At the money is going to be somewhere right around 307. How did I also know that? Because that's where purple and black meets. How did I know to buy this ask and not this ask? Because this side of my platform represents puts. This side of my platform represents calls. I'm not even looking on this side. They both share the strikes because they're all the same, but the calls are on the left, puts are on the right. All right. So at the money is going to be 307. So even if your buddy say, hey, I just bought a put at the money, it's still at 307 at the money. In the money is anything lower than 307. Out of the money is anything higher than 307. So let's break this chart down. Let's just say we wanted to buy a Apple option with an expiration date of May 22nd. Let's just say it's May the 15th. And you want to buy an at the money strike. It's going to cost you $695 or $540, depending on which one you want. And there are reasons for buying some that are lower than higher. Okay. The higher that you go, let's say I wanted to pick this option out here, that's 320. It's going to cost less. And this is what a lot of people don't realize. All of these options move. If this stock moves up $1, all of these options go up in value. All of them. If this option goes up $5, every single one of them goes up. If this option goes, if the stock price goes down $5, all the options are going to go down in value. So you got to figure out, why would I buy out of the money or in the money or at the money? I'm going to show you guys strategy. All right. We're going to get there. We got to first figure out how to do this first. All right. Because a lot of you guys are confused. So break even is the reason why people pick different option strikes. Because although everyone wants to rent this, there's a worst case scenario by May the 22nd. On May the 22nd, all of these options has a scenario that has to be met, or you're going to lose all of your premium. Now, does that mean I have to wait till that date? No. I keep telling people that. That's the beauty of options. You have the option of doing whatever the heck you want to up until the date. But if you're going to wait until the last minute, these are the scenarios that are in place that can make you lose all your money. If I wait, let's say it's May the 15th, and let's say in 2 days, Apple goes up from 307 to 320. It goes up $13. I'm up $1,300, and I only spent $200. This option's now worth, $1,300. I can sell it, and anything over the premium is my profit. I can get in and out. I don't even have to worry about this expiration date. But let's say you wanted to be greedy, and you said, no, I was up $1,300 today. I bet you I can be up $1,300 the next day and $1,300 the next day, because that's what a lot of you guys do. Well, if you're going to do that, Apple better be higher than the strike price plus the premium by this date, or you're going to lose this money. I'm going to say that 3 times. Apple has to be higher than the strike price plus the premium by this date. The strike price plus the premium by this date. The strike price, I'm showing y'all bid. The strike price plus the premium by this date. So what is this telling me? This is telling me that if I buy this strike right here for 300, that the strike is 310. 310 plus 4 is 314. 310 plus 4 is 314.10. If Apple is not higher than 314.10 by May the 22nd, you're going to lose $410. I'm going to say that again. If I buy this strike here, this 310, 310 plus 4 is 314.10. If Apple is not higher than this right here, if Apple's share price at 4 o'clock on Friday, May 22nd, if Apple's share price is not higher, the closing is not higher than 310 plus 410, 310 plus 410, which is 314.10 by this date, you're going to lose $410, and any profits that you had, it's all going to be gone. Zero. You're going to look in your account, it's going to say zero. So what does that mean? That means that if you're profiting, you don't have to wait until the expiration date. You have up until that date. Apple right now can go up $4. You can be up $400, and it can never even reach this strike price, and you still profit. You just have the option of waiting until this date, because they said, look, once you buy this premium, you have Apple until May the 22nd. They're yours. They're your 100 shares. Do what you want with it. But on that day, you best have my money. All right? And that's what you're doing. So on the Robinhood platform, it's going to look a little bit different. On the Robinhood platform, let's say you wanted to buy silver. Well, the break-even price, break-even means I'm not going to lose my money. So that means that silver has to be higher than, if let's say I paid $6 for my premium. Well, if silver right now is $20.83, if silver is not higher than the strike price, if I pick this strike, 21.5, because some of your buddies are going to say, nah, I'm going to buy the 20 strike or the $19.50 strike. All right, each strike is going to have a different scenario. This strike says, look, if I buy the 20, think about this, we're at $20.83 right now. So that means if you pick this strike, that means silver has to be higher by that date. So on the 24th, if $20.83 isn't higher then $21.50 plus your premium, which is $21.56, you're going to lose $6. $6. That's the most that you can lose on a call or a put. That's it. Not more than that. You can lose 100% of your investment, but that's the most that you can lose. I know a lot of you guys are still like, but I don't get it, Joe. Why is there an expiration date? Because they're just giving you enough time to do whatever the heck you want to. Well, then, Joe, why would somebody pay $50 worth of $6? Because, why would somebody pay $50 and not pay $6? Because the scenario for the worst case scenario is better. Silver had to be higher than $21.56 in order for you to lose your money. This option, silver only had to be higher than 20. We're at 2083 right now. Hold up, it had to drop in price. It's already above 20. That's what you call deep in the money. But you gotta pay for that. If you go deep in the money and your worst case scenario is better than this, you got to pay for it. So this person said, I'm going to pay $50 because there's no way silver is going to be less than that by, that particular date. This person said, I ain't going to spend $50. That's 8 times how much I have to spend. I'm going to spend $6. And if I lose the $6, great. This person said, I'm going to risk 50. This person says, I'm going to risk 6. This person could have bought $50 worth of it just by buying 8 contracts. Okay. But their worst case scenario, what the stock price has to be higher than the expiration date is a lot worse than 20. We're at 2083. This is worse than that. Now, if silver goes up $1 in the next 25 minutes, every single one of those options make money. Every single one of them. So that's why day traders never go deep in the money when they're trading day to day. They're like, why am I going to go here when I can spend $6 and look for $1 move? I can get in and out and I'm done and make a higher return on my investment. So you guys got to know which ones to look for. We're going to talk about that. All right. I'm going to make sure I break it down for you. But it's always the strike plus the premium is your worst case scenario. We're going to say that together. Say it with me. The strike plus the premium. The strike plus the premium. The strike plus the premium equals your worst case scenario by this date. You have to know that. I got to know how I can lose all my money. And once I know what that amount is, I'm fine. And I can get in and out of this stock anytime I want to. I can sell it for a profit or a loss because this premium might go up to $8 cents. If it goes up 8 cents, that means I'm going to be up 2 cents. If it goes down up 2 pennies, I can still sell it for a 2 penny loss. And I can sell it before the expiration date. Okay? So you don't have to wait until the expiration date to collect your money. And a lot of people keep thinking that you have to. No, you do not. So how does that order look? It looks like this. All right, if I was buying Apple, all right, we know that this is at the money because that's where purple and black meets. So the at the money strike, we knew that Apple was somewhere around $322. But buddy of yours said, hey, I just bought Apple at the money with a June 5th expiration date. You're going to say, all right, did you buy the 322.5 strike? You're going to say, yes. How much did it cost you? $310. You're going to say, oh, shoot, Apple, if you wait until the last day, Apple has to be higher than 325.60 or you're going to lose $310. Your buddy's going to say, I don't care about that. I'm just trying to make money in the next couple of days. I ain't even looking at the break even. But I have until that day just in case something goes wrong. All right. So the order is going to pop up. If you wanted to buy one Apple contract, it's going to control 100 shares. The expiration date is June the 5th. The strike that you bought was the 322.5 strike. That was at the money because we know that where the purple and the black meets, that's where the stock price is probably at the moment. Okay. Your premium cost you $3.10. So we know that's $310. All right. So you paid $310. And I know a lot of you guys are like, well, why is the bid 300? A lot of you guys always go ahead. Well, what is this open interest and volume? Focus on this first. We're going to get to that. All right. You always buy on the ask. Don't buy on the bid. Don't even look at this price. This is what you paid. This plus this is your worst case scenario. And you're going to also pay a small commission, 65 cents per contract. That means if you bought 10 contracts, it's going to cost you $3,000, 3,100 bucks, and it's going to cost you $6.50 for the commissions. And once you hit send, you'll own that option up until this particular date. $1 million question. Well, what happens if I go into a coma, Joel, and the Friday expiration comes? What if you wait until the last day? Well, if you wait until the last day, if you paid $310, and as long as Apple is above 325.60, you're going to make the difference. So let's say you woke up and Apple was sitting at $330.60. That means Apple would have risen $5 in price. $3, what did I say? $330? Well, $330 higher than the strike price is what? $8. $8 times 100 shares is $800. You're going to look in your account on Monday and you're going to see $800 in there. All right. Plus the premium is already there. So you're going to keep your premium. You're going to just see an additional $8 because Apple closed on that day $8 higher than the strike. You're going to keep your premium and you're going to get whatever the dollar amount is over the strike times 100. Okay? Because you're controlling 100 shares. So if Apple goes up $10 and you own 100 shares, you're going to be up $1,000. All right? And you keep your premium. Okay? So that's the beauty of this. You don't even have to wait. Now, what if you wake up and Apple is sitting at $324? Let's say Apple was sitting at $325.59. Well, you're not going to see anything. It's going to take your $310. It's going to be gone. Now, when you buy an option, they're not going to debit it out of your account. Let's say I have $310 in my account plus the commissions, and you buy the option. Well, you're going to still look in your account. It's still going to say 310. And then if this option goes up $5, your account's going to go up $5. If your account goes up $10, it's going to go up $10. If it goes down $50, your account's going to say $260. All right. So this is going to fluctuate with whatever the premium is doing. And then when you wait until that particular date, once that happens, as long as Apple is higher than 325.60, you're going to keep your premium. You're going to make whatever that difference is in the closing price and the strike price times 100. So if it's up $5 times 100, you're going to be up $500. Do you have to wait until the expiration date? No, I told y'all that. You don't have to wait until the expiration date. You can sell it in two minutes if you want to, but that's going to be up to you. All right. So we're going to go off to the charts. All right. So I can show you guys quickly how it looks when you're buying a particular option. And I want you guys to compile your questions. We're going to start, once I finish this, we're going to come back. I'm going to answer a couple of questions for you guys. We're going to take a 5-minute break. All right. Well, first of all, we're going to come back. We're going to take a 5-minute break, and then I'm going to answer your questions. Okay. But for now, let's go to Thinkorswim. So this is Thinkorswim, just waiting for it to log in. This is the TD Ameritrade platform. This is Thinkorswim that's offered by TD Ameritrade, okay? So let's say we compiled a list, all right? So this is kind of confusing here. So I'm just gonna put a clean chart on here for you guys. Let's just look at a clean chart. And let's just say you were looking at Apple and you just decided that you wanted to buy Apple just because you wanted to buy Apple, right? You see it, this is the 1-minute chart, okay? You think Apple's going to go up in price. You decide, hey, I want to buy Apple. And you look at your charts, which I'm going to teach you guys how to do. You saw that Apple was at $137 and you decide, hey, I think Apple can go from 123 to 137. Well, first things first, let's take out a calculator and figure out how much money we can make. Well, if Apple goes from 123 to 137, 137 minus 123, I can make about $14 if Apple just goes back to its original highs. Well, how long did it take for it to drop from that price down to about the price that we're at right now? Well, it looks like, if I'm looking at a day chart, it looks like Apple moves. Now, the easiest way to figure that out, guys, is by looking at the ATR. All right, the ATR is the average true range of a stock. So let me see that list. Let's look up Apple. And I do this during my chart setup. Apple moves daily $3. All right. It moves from the lows to the highs. Apple usually fluctuate about $3. All right. So even if Apple went up $3 every single day, even if it was going to go to 138, I got to give myself some time for it to go to 138. Right? So that's a $15 move. If it moves $3 a day, even if it maxed out its moves, that's 5 days. Well, I'm going to always double or triple that amount. So I want to go about 15 days out. Well, I'm looking right now and I see that today is the 10th. I'm going to go to maybe the 25th or the 31st. So I'm going to pull up my options. So the way that you pull up your options is when you see Apple, you're going to go here where it says all products. When you click on all products, you're going to see an option chain pop up. We want to make about $15 on Apple. All right. So let's say we wanted to buy Apple. And if you bought it, if you think it's going to move $15 and you're trying to get that maximum move, you might want to go out of the money. If you just want to ride Apple for its price going up, you don't have to really you don't have to pick $15 out. I'm just giving you guys one strategy. All right. Let's say I want to kind of capitalize on its movement up. Well, I have a couple of options. So if I go to the 24th or the 31st, I'm going to look at my option chain. So here's my option chain. Here's the dates. I went to December the 31st. I'm going to control 100 contracts. Well, I'm going to buy single spreads, okay? And I usually want my volume to show. Why? I'm going to show you guys that later. But I want my volume to show. So then when I go to this particular date, I'm going to try to figure out which option I want to buy. Do I want to pay $340, $775, $166? Well, first things first, it's going to cost me right around $385 if I buy it at the money. Well, what is this scenario telling me? Well, if I buy this option and I click on it, I want to buy one contract. If I bought one contract of Apple that's going to expire on December the 31st and I'm buying a call, it's going to cost me $385. A limit order means that price or better. So if I'm placing an order, limit means no matter what I put, it's going to give me that price or better. If I put $375, then until this option drops to $375, it won't buy it. So I might say, hey, I want to save myself $5. Let me buy this option for $380, but let me look and see what it's telling me is going to happen. Well, if I buy this Apple option that's going to expire December the 31st, my profit is infinite. Word? Yeah, because the profit if Apple goes up $1,000 a share, you capitalize on all the upside. But look at my maximum loss, $380. Wait, hold up, Joel. You mean to tell me I can make $10,000 and the most that I'm going to lose is $380? I'm like, yeah, you limit your risk. You can make all the upside. Well, Joel, why isn't everybody doing this? I'm like, I don't want everybody to do it. I just want the top 10% or 1% to know about this. I can limit my downside. I can rent these shares and not even own them, and I can make all the upside? Yes. Well, sign me up. I'm trading tomorrow. All right. So you limit your downside. The maximum I'm going to look. And look, Thinkorswim wouldn't put this here if it wasn't the maximum loss. 380, that's it. But my profits are infinite. Now, if I wait until this date, if I get greedy and say, I'm going to wait till the last day. Well, Apple is at 123.24 right now. That means Apple still has to go up a little bit. It has to go up at least $3.40 and be higher than that by the expiration date. Now, here's the $1 million question. Let's say you bought this option at 9:30. And let's say this option went up $2. It went to 125.24. Are you going to be profiting? Most of you guys are going to say no, because it has to be higher than the strike, because that's what my cousin told me. No, you're going to be up roughly about $200. Wait, hold up, Joel. Hold up. You mean to tell me that I can buy this option at 9:30? It never even has to reach this strike. It never even have to wait till this date, and I can still make money? I'm like, y'all don't remember what I did just an hour ago? I showed y'all. I bought an option. I was out in 3 minutes with a $30 profit. You don't have to wait. You have the options. That's why it's called options. That's why it's the ultimate trading tool. All right. So you have to figure out what you want to do. Now, some people are still lost. Well, Joe, I just don't get it. Why would somebody pay $7.75 when they can pay $143? Well, look at $143. Watch this. If I choose this option, my break even is $131. Look how high Apple has to go in order for me not to lose all my money on the last day. But what if Apple goes up $2 in the next 5 minutes? Wouldn't I profit? I'm like, yeah. Well, why wouldn't people just sell then? I'm like, I don't know, but cats do it all the time. It's called greed. And I could have got out. You mean to tell me I could have got out and I never even had to wait 3 or 4 weeks? You mean to tell me I can buy an option 6 months out? It can be up 200% in the next 3 days, and I don't even have to wait 6 months to get my money. No, you don't. You don't. That's the beauty of options. All right. So that's how it looks. Okay. You got to figure out the strike you want. You got to figure out the date you want. You got to figure out the worst case scenario. Okay. We're going to learn how you know which one to pick when we get back. All right. So let's go back. I want you guys to get your questions together. All right. And then when we get back, we're going to talk about the Greeks. All right. Actually, hold on. Let me see something. I think we're going to go through it. Actually, let me go ahead and talk about it now. So the Greeks, how do I know how much money I'm going to make? It's only, we're going to go just a little bit over, and that's fine for me. All right. How do we know how much money we can make daily? Okay. $1 million question. How do we know how much money we can actually make? Okay. Let's say you're day trading options and you're trying to get in and out, because we're going to talk about 3 different time frames today. We're going to talk about day trading, swing trading, and long-term trading. Well, let's say you wanted to get in and out, and you're trying to figure out, Joel, if Apple goes up $1, how much is it going to be worth? Okay. Well, you got to look at what we call delta, and we call these your Greeks. Now, there are 4 different Greeks that are out there. I'm going to send you guys a video. You're going to get a video tomorrow that's going to have the recording. You're going to have 14 days. As a Christmas gift, I'm going to give y'all 14 days. You're going to have up until, actually, I might give y'all up until January the 1st, because I'm not doing any more webinars until January. You guys are going to have up until January 1st to watch this video as many times as you want. All right, for signing up today. All right, you also are going to get another video where another educator is teaching you, and it's a 30-minute video that's going to teach you all the Greeks, because we don't have enough time for me to teach all the Greeks today. But we're going to learn about delta today, because delta, in my opinion, is the most important. I'm going to be honest with you guys. I don't even look at the other Greeks. I don't look at theta and vega, and I don't look at that. I look at delta because I'm a day trader, or I'm trading way out, and I don't really need the other Greeks, in my opinion. But the delta is going to tell you, by looking at that particular option, if the underlying, which is that actual stock, if it goes up $1 or down $1, it's going to tell you how much you actually make per option. So it looks like this. Let's say I bought Apple, and I bought Apple here, and it cost me $330. And I see another option up here for $15.30 and another one down here for $90. What does that mean? All right, let's say at 9:30 you had $1,535 in your account. You said, I'm going to go buy one contract of Apple, because in actuality, one contract of Apple is worth $34,299. Okay? Because that's 100 shares. One share is 342. 10 shares is 3,000. 100 shares is going to be 34,000. Well, you don't want to commit $34,000. You only want to spend $1,500, and it's like you had $34,000. Well, if you had $34,000 worth of Apple and you had 100 shares, and this goes up $1, you're going to be up $100. For every dollar move, you're going to be up $100. Well, you could have either used $34,000 or you could have used $1,500. $34,000, $1,500. You're going to make the same amount of money per dollar move. How did I know that? By looking at the delta. Delta tells me that for every dollar move, you're going to make $100. This particular option says, instead of paying $1,500, and that's why I kept telling you guys in theory, down here, if I buy this option for $90, if I look up and I see that Apple moved from 343 to 346, let's say I bought an option at 9:30 and I only spent $90, and I see Apple go up in the next hour, it went up $3. Well, I spent 90, but I got to see how much money I make per dollar move. Well, the delta is going to tell you that. Delta says for every dollar move, I'm going to make $14. Word? So you mean to tell me, Joel, that in 1 hour, if Apple went from 343 to 346, I could have spent $90 and I would have been up $14 times 3, which is $42. I would have spent $90 and my option would have been worth $42 on top of that 90, which is roughly what, 130. So this option is going to be worth $132 in another hour. If this goes up $3, I'm going to say yes. You're going to say, wow, I could have made a 50% return in an hour trading this particular option. This person says, I'm going to spend $1,500 and make $300. Same move. Let's say from 9:30 to 10:30, this goes from 343 to 346. That's a $3 move. This option, you would have spent $1,500. In 1 hour, it's going to be worth $1,835. That means you would have made $300, or you would have been up $300. $300 divided by 1,500 is about what, a 20% return. Okay, because 300 times 5 is 1,500. In this scenario, same scenario. Apple goes from 343 to 346. But I'm only going to make $14. They make $100. They make 14. This person makes 43. That means in this particular scenario, this option would have been worth $129 using $330. This one, you spent $90. It would have been worth 42, about 50%. 50% return, 20% return, about a 30% return. The more that you go out of the money, the higher your return on investment is going to be. I could have spent $1,500 on options here. I could have bought 15 contracts and I would have been up roughly about $700. This person used the same amount of money and was only up $300. Well, why would they spend this when they can go here? Because of the worst case scenario. See, we're talking about something that can happen in the next hour. That's why traders love going out of the money for trades that they don't have to wait until the expiration date. But if we waited until the expiration date, this scenario is going to be easier to hit. Why? Because if we waited till the expiration date, The strike plus the premium is what? 330 plus 15 is 345. This scenario is already higher than 345. It's 357 plus 90, which is what? 358. 358, 345, 345, 358. This scenario is harder to hit with time, but it's going to make you the most money in the meantime. So you got to figure out, hey, if I'm going to go out the money, maybe I don't want to wait till the expiration date. And maybe if I'm going to wait until the expiration date, maybe I want to go in the money. I always tell people to buy here or here. I never buy in the money. So you don't ever have to worry about me buying deep in the money. I just don't do it. I'm either going to buy at the money or I'm going to buy out of the money. And I'll show you guys how to apply that in a second. Another thing I like looking for is volume. Trading volume is the number of shares or contracts traded in a given period. I look at volume because volume is just like looking at volume is just like using legal insider trading. You're like, what? I'm like, yeah, it's legal insider trading. We literally can go in and see what the big boys or women are buying. I can go in and see what contracts and what strike prices everybody's placing bets on. And those are the volume, those are the strike prices that I pick. If I see two strike prices, I see an at the money strike and I see 1,000 contracts. And then if I see an out of the money strike that has 50,000 contracts being bought, I'm going to buy the one that's 50,000 because somebody got a tip and they trying to make the most money that they can. Because remember what I said earlier, if you go out of the money, you get a higher return on your investment, especially if it hits that strike price. Okay. So this is how it looks. Let's say you were debating on which strike to buy. You were like, dang, should I buy this one for $870, $695, $540, or $410? I don't know. I have $870. I could buy two contracts here or one here. You look at the volume. Which one has the most volume? This one and this one. So I'm either going to pay $695 or $410 because this has 20,000 contracts bought. This only has 9. This only has 99. Why would I buy this one? Everybody's betting on this and this. So you can use volume and you can pull up your volume by pulling out the layout. You hit layout and then you look for volume open interest. It's going to tell you, how much volume is being done. I don't really look at open interest. It's important as well. It shows you which strike prices are active. People might have orders on it to sell, but I like looking at volume. That's actual contracts being bought. Let's say I wanted to buy out here. How do I know which one to buy? Well, which one has the most volume? This one, they all got 3,000. I'm going to go with the one with the most volume, especially if I'm going to buy at the money. If I had to choose between that one and this one's more expensive, but guess what? More people are placing bets on it. This is more likely going to hit. Even if I was buying puts, which one has the most volume? That one. Well, if I was shorting the market, that's the strike I'm going to go with, the 300 strike. It has the most bets. I want to go with the most volume. Okay. All right. So there's 4 steps. There's 4 steps when you're you remember we talked about these 4 steps earlier. You want to analyze a stock. You want to pick an expiration. You want to pick a strike price. And it makes a lot of sense now. You want to calculate the worst case scenario, which is the break even. Okay. Again, you want to pick a stock. You want to figure out how long you're going to rent those 100 shares. You got to figure out how much that option is going to cost you. And then you got to figure out how much you can lose. What's the maximum amount that I can lose? Great. Am I going to buy this short term or long term? We'll figure out how to analyze that the second half. But for now, I just wanted to teach you guys how to buy the options. So when we come back later, I don't want your questions to be about strategy. We're going to get to strategy, believe me. All right, but we got to figure out how to buy it first. I just want to make sure that you guys are comfortable in understanding what a strike is, how to calculate your break even, okay? And that's what we're looking at right now. All right, so we're going to watch this video, quick video. We're going to take a 5-minute break after that, okay? Hello, traders. It's 9/28, November the 13th. We're doing a webinar later, and I wanted to show you guys a live options trade. So today, we're going to buy an options trade. This is the Thinkorswim platform. The market is going to open up in 2 minutes. So we're going to buy one options contract, and we're also going to buy one share of Apple. And I want to show you guys the difference in how they move. I'm going to tape early, and then I'm going to show you where the profit may be or the losses may be later. But for now, let me show you the option chain. So when you pull up Apple, you put in the ticker symbol here, you're going to get an option chain that pops up. And right here, it says option chain. All right, we're going to be buying naked calls. All right, that means we're going to be buying call options, meaning that we want the stock to go up in price. This is where you pick what type of option you want. There's so many to pick from, but today we're just going to concentrate on naked calls, singles. All right. Anytime you see this color change, this is at the money, meaning the stock price of Apple right now is around $262. So if you want to buy at the money, you want to buy an option here or here. You also, if you want to know about how much it will cost, you just take this decimal point over 2 times. So an option contract here will cost me $299. This one would be $184. This one would be $440. Now the market just opened. So this is live. All right, we have not put in an order yet. So we're going to buy this option here. And if you notice, if we want to buy this option, we want to buy one contract. So we're going to take this down to one contract of Apple. We're going to do a weekly option, meaning that it will expire at the end of the week. And we want this to go up in price at 164. So this is as you can see, it's going down. So I think I want to buy it now. So when I hit confirm and send, it's going to tell you that it's going to cost me $161 plus commissions to buy one contract of Apple. So it's only going to cost me $161. So we're going to go ahead and hit send and see if that order takes. In the meantime, we're going to also buy one share of Apple. So we're going to go ahead and get in immediately by buying a market order. This is the active trader screen. And I'm going to buy one share of Apple at $261.47. Our option just took. And we're going to buy one right now. So we're just going to get in right now. So now we own one share of Apple that we paid $261.57 for. And we also bought one options contract of Apple. We spent less money on the options contract, but we're going to see which one pays off in the long run. So when you pull up your orders, you go to your monitor tab. And as you can see, we're already up $16. I can sell right now and have made, $16 today. Isn't that kind of cool? We've been in the market for 2 minutes and we've already made our $10 an hour. Now the price is going down at this particular time, but we own one share of Apple and we also own one contract. So you see here, 1 and 1, that's one share of Apple. And we own one contract at $1.61. All right. Anything that's higher than 161, we profit. Anything higher than 261.57, we profit. Right now, look at what the option is doing. The option is already up $11. The share price is only up 20 cents. You see this? Options up $11. Share price is only 28 cents for now. We spent more money buying the Apple contract than we did, the Apple share price than we did the contract. Contract right now is up 18 bucks, 21 bucks. Apple's share price is only up 50 cents. So you see how in like 3 minutes time, just by buying an option, we have more leverage, meaning if it goes our way, we'll make way more money. And that's why most people buy options instead of buying the stock. We use less money and made more money in a shorter amount of time. I'm going to go ahead and get out of these particular, I'm going to go ahead and get out, and I'm going to show you guys how to do that as well. So if I want to create a closing order, I want to sell my one weekly at 180. Go ahead and hit confirm and send. And we're going to also get out of this Apple contract. Apple share price, I'm sorry. I'm going to go ahead and do market for that one. And if you really want to get out immediately, you just hit market. Looks like this is not taking. Oh, and there we go. And look at there. In 4 minutes time, we made $19 and we were using roughly about 400 bucks to make that $20. But that $181 that we used to buy that contract, look, we made $19 in 4 minutes. And that, you guys, is buying options contracts. All right. So that's buying options contracts. Okay. So before we take a break, I want to quickly show you guys a vertical. All right. A vertical is just a debit spread or a cheaper option. Okay. It's just a cheaper option. So let's say we were trading, and I want you guys to look at Tesla. Let's say we were buying Tesla, and you guys got to excuse my printer right now. I don't know why it's printing right now. All right. But you guys got to understand that, let's say you wanted to buy Tesla, and Tesla's strike price was 7,000. At this particular strike price, you see that it's going for $7,000. Well, you might not want to spend $7,000 to get into a Tesla trade. You know, that's a lot of money. Well, you can buy what we call a debit spread. A debit spread is basically two different strikes where you're selling at one and buying at another. Very difficult to create. And we're not going to spend a lot of time on it. I just want to show you guys the debit spread because we're going to look at some when we do scenarios. All right. That same debit spread at that same strike, instead of spending $7,000, I can spend $180. And this was today. That same Tesla option that cost some people $7,000, they had no idea they could have got into that same option for $180. That's a huge difference because the higher the stock price, the higher the options price is going to be. And every option, you might not want to commit that type of capital to it. So most people don't know about verticals or debit spreads. It's called a debit spread. All you have to do is go to your spread button and click vertical. On the Thinkorswim platform, it creates it for you. So let's say I was looking at a debit spread. Let's say I was looking at Apple and I wanted to go out to January 21st. It's going to cost me $430. But when I go to pick that particular vertical, regular call, that's a regular call single, my maximum loss is $430. Break even is 128. Well, watch this. That break even is 128, which is $5 more than that. I'm going to be risking $430. Let's say I don't want to risk $430. Let's say I want to risk less. Same expiration period at the money. Instead of spending $430, I can spend $60. And I can go with the one with the most volume. So I would pick this one. Now watch this, guys. You remember how my break even was $5 higher? Look at what my break even is. It's only $1 higher. But when you pick a vertical, there's a maximum amount of money that you can make. When you buy a regular call, the maximum profit is going to be limitless. Whatever the price is when it closes, whatever the difference is over the strike, you're going to make that money and keep your premium. Not with the vertical. The vertical is going to tell you the maximum profit is $55. You're still going to be able to keep your premium, but you're going to make $55 on top of that, which is still, a pretty decent amount of money. You're going to make 100% return if Apple is higher than 124.45 by this particular date. If you try to do this on the Robinhood platform, it's going to be a lot more difficult to create. I don't even encourage people to do it. But on Thinkorswim, they're going to create it for you. All right. So that's your debit spread. All right. Cool. So we're going to take a 5-minute break. It's 7:53 now. We're going to come back and let's go ahead and make it 7 minutes. It's 7:53. I want you guys to be back by 8 o'clock. I'm going to be ready to answer any questions that you guys may have. And I'm going to try to get through it. All right. The next hour, I'm going to really try to get into the meat of it, which is applying strategy towards what we're doing right now. So I'm going to talk really, really quickly. And then we're going to go over a little bit, but at 9 o'clock, that's when I'm going to shut it down. And that's when I'm going to start doing the charts with Joel. And that's when I'm going to answer any questions and I'm going to do scenarios. So I'm going to get through the rest of the webinar by 9. But anybody that has something that they have to do, go ahead and go do it at 9. But we're going to stay on a little bit longer and I'm going to give you guys a treat and I'm going to analyze every single one of you guys' stocks that you give me, as long as you give me one, and we're going to look at the option for it. Okay. And I'm going to try to answer any questions that you guys may have. So it's 7:54 now. I need everybody back by 7:59. Later. All right. I'm back. I know it's a little early. I'll wait for a couple of people. As soon as it changes to 7:59, I'll start. Oh, we just turned to 7:59. I was right on point. All right, 5 minute break is over. All right, I want you guys to empty your mind. Empty your mind. Anything that you've learned in the past about options, I want you to throw it out the window. We're about to approach the market a different way. Okay. All right. Before we even start, though, let me get to some of these questions. All right. Question came in. This is a very all right. It says if you buy an option contract and a stock contract, which I guess that means maybe stock shares in the same company on the same day, then 1 year and 1 day later, you exercise your option contract. So now you own 101 stocks in that company. Will the 100 stocks purchased from that options contract be taxed as a long-term versus short-term capital gains, assuming you close your position 1 month after exercising the options contract? Very complicated question. I don't usually answer tax questions, so I apologize for that. You definitely want to talk to a CPA. I let my CPA handle all of my profits or gains. But usually if you sell anything for a profit, usually you have to pay capital gains that particular year, unless it's in a retirement account like like an IRA, a self-directed IRA. But you definitely want to talk to your CPA. Have the option, guys. Let's say you wanted to buy a stock and you didn't have the money yet. Let's say you knew that you had some money coming in. Let's say you had a bonus coming in for $100,000, but you knew that Tesla was going to go up in value, and you're like, dang, I don't have the 100,000 now, but I want to own $100,000 worth of Tesla. How can you capitalize on the gains of Tesla? And you still want to own the stock forever, but you don't have the money. Well, you can buy an options contract. And if you buy that particular options contract, you have the option at the expiration date. Now, it won't do it unless you call your broker, or there's a button. And I've never done it myself. I'm just going to be honest with you guys. I've never exercised an option. I encourage you guys to call your broker and ask them how to do it. But you can exercise your option. And if you have enough money to cover the 100 shares, then instead of having the profit that shows up in your account, you're going to have the shares, which is going to show you the profit. So you're going to be able to you're going to be able to exercise your option at that strike price that you picked. Okay. And anything higher than that, you're going to buy, like, let's say you pick $126 strike, right? You got to buy 100 shares at that particular strike for every contract. All right. So you're going to have 12,600 bucks. Well, as long as you can afford it in your account, if the stock price is at 130, it doesn't matter. You're going to be able to buy 100 shares at that strike price that you picked. So on the expiration date, whatever strike you have that you picked above the premium, you're going to be able to exercise that option at that price. And then once the funds are in your account, now you can exercise that option, and now you can own however many shares you want to. I know a lot of people that have done that before. They didn't have the money. They knew money was coming in. They wanted to buy that particular stock. They didn't want to wait until that day, so they went into the options world in order to do it. And even if that money didn't come, they still would have had the profit from it, because remember, you're controlling 100 shares of that company. So that's a pretty good question. All right, the next question that came in is, why do you like to buy call options and puts at the money? Well, we talked about that earlier. I like to buy at the money or higher because I'm a technician. And, as a technician, the at the money strike usually is the best risk to reward. They're going to always, most options traders, when they teach They always teach to start there first before you start going deep in the money or going way out of the money. At the money is like the basis of buying options because it's at the same price that the stock is at that particular time. So it's literally like buying Apple. If I look up, I see Apple's 105. It's literally like buying 100 shares of Apple at 105. So that's the easiest way to kind of figure out how much money you can make if Apple goes up or if Apple can go down. Okay. Another question came in: how do we set up our charts on TOS? Again, earlier I showed you guys my PayHip. It's called, you can go to www.payhip.com/whatwould-Joel-do. I have a Thinkorswim chart set up there. Download that video. You're going to be able to make your charts look just like mine. Everything that we talk about in the next hour, you're going to have access to everything. All right. And you're going to be able to keep that video forever. So that's how you're going to be able to set up your chart. But you have to open up a TD Ameritrade account. Without an account, you're not going to have access to the Thinkorswim platform. Okay. All right. Another question that came in is: sometimes I trade options and I'm down money on that option right after I receive it. Is that normal? It depends on what type of option you're buying. And if you're buying on Robinhood, it usually always happens. Check and see if your settings are live. Sometimes you might be trading and don't even know that you have a live account. Even though it's live where you can buy it, you might not be able to see the settings live. So the price action might be 5 minutes late. So you might buy an option that costs too much. So there is going to be an ask and a bid. I know I told you guys to focus on the ask. But what a lot of traders like to do is, if whatever the bid is and whatever the ask is, they'll try to buy somewhere in between there. So if they see a ask for 110 and a bid at 100, they might put in a limit price at 105 so that they won't have what we call, that slippage there. Pretty good question. All right. Last question: if I buy a few contracts, can you sell some or do you have to sell them all? Very good question. It's just like buying stock. If I bought 100 shares of stock, I can sell 99 of them as long as there's somebody out there that are willing to buy them from me. And that's something that I want to talk to you guys about as well. When I buy options contracts, I want to make sure that there's enough volume behind the strike that I buy, because options contracts are the least liquid market that's out there. I'm going to say that over and over again. It's the least liquid market that's out there. What does that mean? That means if I'm buying stock, if I'm buying something like Apple and it's 9:30 to 4 o'clock, whatever the price is at that time, when I hit the sell button, I can almost 100% of the time get out of Apple in a split second. It's not that way in the options world. The options world is not as liquid as the stock world. So there's been many a times, I know you guys have tried to hit the sell button and your option wouldn't sell. So what I tell people to try to do is, sometimes you might not have a strike price that has enough volume. That volume should have at least 1,000 contracts or more, in my opinion. If you have more than 1,000, you're more than likely going to be able to get out of it when you want to. If you're having trouble getting out of that option, try to sell it for a cheaper price, or a higher price. Cheaper or higher, either or. And then sometimes you can get out of that particular option. All right. But to answer your question, you don't have to sell all of your contracts. And I don't encourage you to do it. Let's say you bought 10 contracts or something, and then you're up 100% in 5 minutes. I tell people to do this all the time. If you're up 100% really quickly and you own 10 contracts, sell 5. Those 5 just paid for it. That's your initial investment. You can let those 5 run until the expiration date, because you already made your initial investment. So everything you're playing with now is the house's money. All right. So I like to trade stock that way. I also like to trade options that way. Very good questions. But first things first, the trend is your friend until it ends. Y'all are going to see this in every single solitary video that I have. All right. Because a lot of you traders have a hard time understanding that when things go up, they go up. When money flows into something, it goes up. When a stock is bullish, it never comes back to the price that it started at. I see so many people that saw Tesla run from $100 to 1,000, and they're like, all right, I'm going to just wait until it comes back to $100. And I'm like, hold your breath. It ain't coming back. And if it does come back, there's something significantly wrong with that company. So you guys got to start understanding that the trend is your friend until it ends. When you see momentum, you guys got to put on your traders caps, and you guys got to understand how to approach the market. I talk about that in the stock party, how to look at the market from a short-term perspective and from a long-term perspective and from a medium-term perspective. If you haven't got your foundation yet, you need to go watch that particular video. You also need to work on your risk to reward. The things that I'm showing you guys right now is the number one reason why traders don't make money in the market. It has nothing to do with the option that they're picking or what they're trading. I have so many people that are like, don't trade Tesla or don't buy Bitcoin or don't buy this, that, and the other because you're not going to make money. That's the dumbest thing I've ever heard in my life, because I've seen people make money off of let's say you were in real estate and I saw a triple murder in the house across the street from me. Guess what? That house ain't going for $0. They're not going to give away that house for free. That house is going to sell for a certain price, right? So there's no such thing as a bad investment, because it's going to be valued at something at some price at some point, and somebody's going to buy it for a deal. If I buy the house across the street from me for $1 with a triple murder in it, best believe that was a good investment, even though somebody would tell you don't buy it because people have died in the house. Don't listen to people that tell you what you can and can't buy. There's no such thing as a bad investment, just bad investors. So one of the big reasons why people lose money is risk to reward. I can answer 99 of y'all's questions just by this. So let's break it down. What is risk to reward? Risk to reward is how much you're risking versus how much you're going to make. This is the reason. This is what separates the cream from the crop. I mean, from the cream from this separates the best from the worst. You always want your reward to always be greater than your risk. So let's say I take an option and I pay $500 for that option. All right. I want to figure out from the jump, how much of this option am I willing to risk? How much am I willing to lose? Some of you guys don't even think that way. Joel, I don't even think that way because that's negative, brother. And I'm like, no, that's actually fiercely protecting your capital. How much are you willing to lose? If you don't know how much you're willing to lose, you're not an advanced trader and you're a terrible businessman or woman. How much are you willing to risk? All right, Joel, if I put up $500, if I'm down $100, it's hurting me. I don't want to lose 100. Well, then that's what your risk is. Your risk isn't the whole 500. Your risk is how much you're willing to sell it for if it goes down in value. If your risk is $100, guess what your reward has to be? $100 or more. That's what separates the best from the worst. Great traders like myself always make sure that my profits are going to equal what my risk is. If I'm willing to risk 100% of my option, this is why most of y'all lose, because you're willing to risk your whole options contract, but you're not willing to hold it if it's up 100% or more. If you're willing to risk the whole thing, then you need to be making 100% or higher. And that's not what a lot of you guys are doing. You'll take a $500 option and you're willing to risk 500 on it, but then when it's up $100, you're going to take your profit because I made my $100 for the day, Joel. I made my $100. You'll win 4 times in a row. Monday, Tuesday, Wednesday, Thursday, you'll win $100, $100, $100, $100, and then lose on the 5th day. And you lost a $500 on Friday. And then you call me up and spend $100. And you're like, Joel, I don't know what's going on. My trading is terrible. And I'm like, no, it's not. You just should have risked $100 on day 5 and you didn't do it. All right. Your risk must have been $100 or less, because if you're taking $100 every day, your risk has to be $100 or less. So if your option drops in price, you got to sell it for a loss. Otherwise, you're gambling. You're not approaching the market like a businessman or woman. Elite traders win 65 to 75% of the time. All right. I win 4 out of 5 times of the week, maybe 3 out of 5 times of the week. I can win 2 out of 5 times of the week and I still profit. Why? Because I risk a little bit to make a lot. Elite traders are going to risk $100 to make $200 or $100 to make $500. Y'all hear what I just said? Elite traders risk $100 to make 200 or 100 to make 500. Now, that doesn't mean that every day elite traders are risking $100. That's just a ratio. If I have a $1 million account, you know what I'm saying? Or let's say I'm risking $1 million, then I want to make $5 million. So I can lose $1 million on Monday, $1 million on Tuesday, $1 million on Wednesday, $1 million on Thursday. Then on the 5th day, I make $5 million. I just made all of my money back and I only won 20% of the time. That's what separates elite traders from novices. Most of you guys are not going to get this because this bores you to death. And I don't want to take a loss. I'm not going to tell my spouse or my friends or my parents that I lost on the first day of me taking an options trade. Are you kidding me? The expiration is Friday. I'm just going to wait till Friday. That's where you guys go wrong. Okay? You gotta stick to your guns. That's what's going to separate you and make you rise to the top. All right? So there's a simple option strategy we're going to go by, and we're going to talk about it quickly. There's only 3 charts that you guys should be looking at: a 1-minute chart, a 1-hour chart, a day chart, a 1-minute chart, a 1-hour chart, a day chart, a 1 minute, a 1 hour, or a 1 day. So let's say you want to buy Apple. You want to make money in the next 14 days. What chart are you going to look for? If I'm trading within 30 days, I'm going to look at a 1-hour chart. But Joe, the day chart is what I was taught to look at. Well, we're not going to use that anymore unless you're going to be in a trade 30 days or longer. Well, what if I'm going to get in and out the same day? Then you don't need to look at this chart or this chart. You need to look at a minute chart. So let's break that down. If you're going to get in and out the same exact day on a trade, there's no need to look at this and this. Sometimes y'all go and study Apple for 3 weeks. Y'all know all the ins and outs of Apple. And then you want to go day trade Apple. And you're looking at the wrong charts. And then you're wondering why you ain't make money that day. Because what happens in the next hour has nothing to do with what Apple did for the last year or couple of weeks. Apple can be bullish for 9 days. And then the day you decide you want to trade, Apple decides it doesn't want to go up. Because y'all minds think that when a stock goes up, it goes up every single day. No, it don't. Stocks don't go up every single day. They do trend in one direction 80% of the time. But most of the time, 20% of the time, they're going sideways. So yeah, they are going up, but there are days they go down. And it's so funny to me, those big days the market goes down, I lose 90% of my trading room. I'm like, how did y'all make money from March all the way till December and you got wiped out in 2 days? Because you're using the wrong charts and your risk to reward is off. Period. I told you what to focus on. So 1 minute, 1 hour day. So let's say you wanted to be in a trade for 90 days. I'm going to look at a day chart. Is there any need to look at this and this? Nope. Let's say I want to be in a trade for 17 days. Do you look at the minute chart? No, you look at the hour. If I want to be in a trade the same exact day, let's say if it's for 5 hours, this chart. Let's say it's for 23 hours, this chart. Let's say it's for 27 hours, this chart. All right. Let's say it's a month and 1 day, this chart. 30 days or longer, day chart, hour chart, 1 minute chart. Now, if you've been struggling as a trader, some of you guys fight me on this. Why are you fighting me on something and you struggling? I don't struggle like y'all struggle because I've separated and I've committed to my time frames. I don't trade on a 1 minute chart and expect to get out the same exact day and then find myself in a trade that lasts 90 days. That's what y'all do because you don't want to hit the sell button. Because then you figure out, oh, for tax purposes, I can just take a loss here. You figure out a way to stay in a loss. And then when you start winning, y'all don't figure out ways to take profits, but y'all will come up with every excuse in the world to stay in something because you don't want to hit the sell. It's the worst thing in the world for any of you guys to hit the sell button. It's easy for me because when I protect my capital, I'm fiercely protecting it. I'm protecting my capital like it's a newborn baby. And I'm in a gun, I'm outside and I'm shooting. I got one hand holding a baby and I'm shooting with the other hand. and I'm protecting that baby with my body. That's how I approach the market. Y'all approach the market with the baby on your chest with no guns, just walking around. Hope the baby don't get hit. I fiercely protect my capital. I want you guys to do the same thing. So let's get into some advanced technicals. So quickly, I want to make sure everybody's awake. Answer this question for me. What indicators do you guys most often use to trade? Y'all didn't think this was coming back. What indicators do you use most often to trade? Some of you guys use moving averages, I see. No technicals. I mean, that's the truth. A lot of you guys are trading with no technicals, just fundamentals. I'm gonna let you in on a secret. If you're buying something and you're not holding it for longer than 12 months, you're gambling if you're not using technicals. If you're not using technicals and you're trying to get in and out of something within 12 months, you're gambling. And if you're trading options and you're not using technicals, it's literally just a matter of time before you lose all your money. Okay? It's very hard to trade fundamentally with options because you need everything to be right. And a lot of you guys luck up because you end up finding things that are going up in value and you have no idea how you made the money. But when you reinforce bad habits, it's just a matter of time before the house wins. All right, so we're going to look at a couple of technical indicators that I want you guys to use. I keep everything simple. First things first, let's talk about support and resistance. Support and resistance are just levels that a stock can drop to. When you're trading options, you literally analyze the stock just like you would with options. It's just that you're owning 100 shares of it. That's it. That's the only difference. The only difference is, am I going to be spending money on one share or 100 shares? Some of you guys can already afford 100 shares. So how would you approach the market with your 100 shares? Well, support and resistance are areas that we look for the stock to drop to. How do you even know where the support areas are if you're not using technicals? Now, I tell people this all the time as well. Billionaires move the market, not thousandaires. Thousandaires is who we listen to mostly because there's not that many people that I know that are billionaires that trade. Most billionaires are investing, or most billionaires have pension funds or mutual funds, and they move the market because they're putting more money into the market. Well, the support areas are the areas where they're buying. All right. We're like jet skis. And billionaires are like cruise lines. So we're quicker. We can get in and out. We can see what they're doing. All right. We can see by looking at volume, what strike prices they're buying. Right. So we want to use these different tools to figure out and give ourselves an edge. Think of support and resistance like we've been using support and resistance our whole lives. All right. Let's say you go to the store. I love eggs, right? Let's say I see that eggs were fluctuating between $1 and $2. I know every time it gets to $1, buy a whole bunch. When they get to $2, I start arguing with the manager. How dare you sell eggs for $2? Then they bring it down to $1. And I'm like, oh, thank you guys for selling these eggs. They're so beautiful, right? But then let's say COVID takes place and it gives a catalyst for eggs to be in high demand. Well, if eggs have been fluctuating between $1 and $2, and then all of a sudden something happens that causes it to be higher in price because of demand, now once you break resistance becomes your support areas. All right. So if eggs start to drop in price, I know what price it's going to drop to the old resistance. And if we break $4 and go to $6, if I see eggs start to drop in price, I know it's probably going to drop the $4. Okay. Use resistance and support areas to know areas where you can buy and sell options. All right. Looks like this. Let's say you see a stock fluctuating. The only way you're going to be able to see this is by pulling up your charts. I see it drop to this price. You might want to buy an option on it. Okay. And you can buy that option and wait until it gets to this high price. Or you could say, bump that. I'm going to be a little bit smarter. I'm going to buy an out the money strike that's going to be cheaper because I believe it's going to hit this particular price. And as it goes up in price, I'm going to make even more money I'm going to make a higher return on my investment, because when you buy out of the money, you get a higher return on your investment, especially if it reaches that strike price. All right, so again, the trend is your friend until it ends. I'm going to show y'all this over and over again. Stocks stair step going up. They stair step. This is the most common pattern you're going to see in the stock market. It's going to go up, down, up, down, up, down. Momentum stocks, they go up, but when they sell off a little bit. And it's funny to me how a stock can sell off this much, and everybody's talking about, oh my God, it's the end of Facebook, and then it starts to go up again. Because our brains think that stocks just go up in a straight line, and they don't. They stair step going up, and they stair step going down. So we use trend lines to figure out, that stair stepping pattern. So how do we know to buy Apple, or how do we know to buy options on Apple way back here in March? And all this money could have been made. You could have bought an option on Apple at the 230 strike, and it rose $100. Y'all know what 100 times 10, what 100 times 100 is? 100 times 100 is 10. You could have made $10,000 on Apple, and I guarantee the option was probably only about $300. Imagine making $10,000 and you only put up $300 just by using trend lines. See, back in March, we knew that Apple was falling in price. See, I teach price action, and by teaching price action, I teach that when things fall in price, that means that's money flowing out of something. When money flows out of stocks, stocks drop in price. When money flows into stocks, stocks go up in price. You make money on money flowing into a company. Think of it like a pyramid scheme, right? A pyramid, not a scheme, a pyramid. The more money that comes in, the more that stock is going to expand. That's where you make your money. So when money comes out of it, it's funny to me that we as humans think that we can outsmart the billionaires. We can't outsmart the billionaires. So when the billionaires are selling, we don't want to start buying because they're slower than us. When the billionaires sell, they're going to sell for a long time. And when they start buying, then we get in. You could have easily just put a trend line here. And when prices fell, as soon as we broke that trend line, 1, 2, 3, you could have known that this trend ended and a new trend had started just by using trend lines, okay? You can also use a Fibonacci tool. I teach this in every single solitary session. What is this? When stocks stair step up, they pull back. And when they pull back, they're gonna pull back 25 to 50% of this move. So if I looked at this move and it went from 140 to 220, 140 to 220, that's $80. Well, what's half of $80? 40. So you could have expected Apple to drop from 220 to 180. Well, guess where everybody started to buy at? 180. You think all of a sudden they started buying more phones here? No. When stocks stair step up, they're going to pull back 25 here or 50 before they go higher, especially if it's a bullish company. Well, how did everybody know to buy it here in March? Easy. This whole move, half of that move was right here. Y'all know what that mark was? Right there, March lows. See that? You could have bought half of this move and bought Apple half off. But if you're not using technicals, you would have never known to do that. You could have caught Apple here. You would have made tremendous gains. You could have bought an option at the money with a 6-month option on it. Or, you could have bought it out of the money, paid less money, and made a higher return on your investment. So let's get into some advanced strategies. All right. Let's look at I use those different tools to figure out how to trade the market. I use support and resistance areas. I use trend lines. I use my Fibonacci tool. Well, then I also use trends to figure out if the market's going up or down. Well, I'm going to show you guys the most commonly used indicator, the most used indicator on the planet, which is the 200-day moving average. And I'm going to show you guys the easiest strategy to use on the planet when you're buying your options. I'm also going to show you a great trending indicator that I also use called the John Carter. I talk about it all the time. It's the best trending indicator on the planet. It's called the John Carter. It's so simple. Once you add it to your charts, All you're gonna look for is 3 consecutive candles. That's it. Red or green, red or green, green or red, red or green, green or red, red or green. All I need to look for is 3 candles. So let's say this went down in price. Think about this. When Apple started to sell off in price, you remember the Fibonacci tool told you to buy it because it was 50% off. But the John Carter told you to buy when you saw 3 consecutive green candles. When it started to sell off, when was the first time we saw 3 candles in a row? Not here, because that's 1 candle, and then it went red. Then it was 1 green, and it went red. Then it was 1 green, and it went red. Then it was 1 green, and it went red. Then it was 2 greens, then it went red. Then it went green. 1, 2, 3, bam. You could have bought Apple right there, never came back. Never came back. You would have made tremendous gains on Apple. That's where I got in. That's where I told my trading room to get in. And y'all know they threw rocks at me and told me I was an idiot and the worst teacher on the planet. And it's like, where are these guys now? They haven't apologized to me yet. They left the room. They out being bitter and mad at some other educator or teacher. I told everybody, I said, look, guys, I've seen this before. I've been doing this for 10 years. The billionaires don't care about people having no jobs. They don't care. The stock market represents the rich. It don't represent the thousandaires out there. I know we want to be a part of this. You can be a part of it by buying and watching what they do and becoming a billionaire. But we're not there yet. We got to watch what they're doing. That's why it was so easy for me. I got stocks that I've been holding from March until now. That's why I haven't been trading. I haven't even been trading this last month or 2 months. I didn't need to. I got trades I've been profiting off of since March, just off of using this tool right here. And it wasn't a fluke. You can go back 10 years and see the same pattern. I'm going to show you guys the same exact pattern. The easiest investing strategy on earth. 30 days or more trading is the easiest way for you guys to make money. I'm going to say that again. 30 days or more. 30 days or more, 30 days or more is the easiest way to make money in this market. But y'all know at 90, I think about 70 to 90% of y'all do. Y'all want to trade 1 to 30 days because it's the laziest way to trade. See, it's hard to get up at 9:30 in the morning and decide I'm going to day trade. I'm going to get in and out of a trade. I'm going to use my technicals. I'm going to try to find stocks that are hot. And then once I get into it, I'm going to manage it. I'm going to fiercely protect it. And I'm going to put my stop at break even. I'm going to manage it by risk to reward. That's hard. Just by me saying it, a lot of you guys is like, that's too much information. Then 30 days or more, or 1 to 30 days, you want to do it also because look, who wants to wait 30 days to get money? Joel, if I put up $1,000 now, Christmas is in 14 days. I need to make like 10 grand in a couple of weeks. That's how most people come into the market. I see 1,000% returns. I want to get them returns, Joel. 1 to 30 days are the hardest way to trade. Whether it's stocks, futures, options, crypto, forex, Bitcoin, I don't care what it is. And I'm going to tell you why. Because 1 to 30 day trading has to be perfect. If you get any negative information whatsoever, that option or that trade or that investment is donezo. It's going to go down in price. You got to give yourself time to get through the waters. All right. There's turbulent waters out there. The market is turbulent. The stocks are stair-stepping up and down. The longer you go out, the higher chance you're going to have to win. 30 days or more are the easiest. So the easiest strategy in the world is to look for the 200-day moving average. What is the 200-day moving average? The 200-day moving average is the average price of a stock for the last 200 days. Okay? The easiest stocks to trade the 200-day moving average on are the top 20 stocks in the world. So what you want to go do is you want to go find the market cap of the 20 largest companies in the world. If you really want to make money, just trade Apple, Amazon, and Microsoft. Because the larger a company is, the easier it is to predict its movements. Y'all know that Apple is the easiest stock on the planet to trade. If you can't trade Apple, trading ain't for you. I tell people that all the time. If you have problems trading Apple after learning what I've taught you, you might want to get another hobby or another way of investing. It's not for you. It's the easiest. I can predict Apple's move. I've been predicting Apple's movements for the last 7 years because it's large. It's the largest company on the planet. There's so much money involved in it. Okay. That's why when we were looking at the technicals, it was falling 50% every single time. It was dropping down to almost a penny on how much it's going to fall because we're using technicals to trade it, and the billionaires are doing the same thing. So the easiest way to do it, and it's the most used indicator. Now, if you've been trading for years and you never heard what the 200-day moving average is, you've been bamboozled. Like your teacher, whoever's been teaching you, probably ain't even a real trader. Because this tool right here is a tool that everybody and their mama know about. It's what you learn day one. It's like playing basketball and not learning how to dribble. Okay? And it's interesting to me that I'm teaching it to a lot of people today. I'm teaching it to people that are learning the market, but there's been traders that's been trading forever and they didn't realize they could be so much wealthier if they just knew about the 200-day. Because everybody uses it. The 200-day is the average price of that stock for the last 200 days. So when you see a blue line that's angled up, you know that price has been going up. That's what billionaires buy. Billionaires do not like putting their funds in a 200-day moving average that's angled down. That's what thousandaires do. Because thousandaires are like, I got to get money. I got to take a chance. Billionaires are like, we already rich. We want to protect our capital fiercely. We want to fiercely protect it. Y'all want to make it? We want to protect it. So it's the easiest way to watch how they trade. They don't buy things that are down. Now, that doesn't mean that they don't buy it. They're just not going to put the whole pension fund or mutual fund in some speculative stock. They're not going to go buy NEO or Virgin and put 90% of the company's money into it. They're going to put in the largest companies out there, the Apples, the Amazons, the Microsofts, the Googles. That's why they're so easy to trade. So what do we look for? We look for the 200-day. We look for a fall to the 200-day moving average. I showed y'all three reasons why y'all should have bought in March. It broke the trend. It went green on the John Carter, and it also hit this line. Anything underneath that was on sale. This is the 200-day. So when you see your stock hit that 200-day moving average, this is the easiest trade. You want to take an option that's 30 days or longer. If you can't afford that option, what are you guys going to do? You're going to buy a vertical. Light bulb just went off, right? So this is Apple again. Let's say we were looking at Apple and we saw a trend going down. Let's use our tools. We're going to use a trend line. When it breaks that trend and starts to go up, what does that mean? That means billionaires are buying it again. Once billionaires start buying it, we don't really know that they're really buying it until you see 3 green go off on the John Carter. Bam. This is the what would Joe do method, by the way. Trend went down, hit the 200-day, broke the trend line, went green on the John Carter. Easiest strategy you ever gonna learn in history. I can match this to anybody that's out there. I don't care what book you read, what trader you talk to. This is the easiest thing you're ever going to learn, and it's going to be consistent, and it's going to work on everything. Not 100% of the time, but it's going to give you a higher chance than probably what you've been doing. You got to go 30 days or more out, though. That's where you go wrong. When you hit this trend line, how many days did it take before it started to go up? Think about it. Some of you guys would have bought this here. This is a day chart. 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, 11, 12, 13. It took 15 days just to start rising. That's why you got to give yourself 30 to 60 to 90 days. The further you go out, the more money you can make. Okay. But you want to give yourself some time for that to work out. Let's say you're doing in stock. If you're buying this in stock, this is why my account went from 250K to 400K in 6 months. By every stock that I bought, same setup. Hit the 200-day, broke it. John Carter went green. I bought it. My percentage is higher than most people that you see out there. Joel started to buy in March and April, knowing that there was 100,000 people out there that was out of jobs. You know, it didn't mean that I didn't sympathize for those individuals. It's just that I'm not following them. I'm following the billionaires. They're the ones that's moving the market. So you can't go off of how you think and what you see outside, because that doesn't represent what the wealthy are doing. All right. So on that 30-day, long-term options, in my opinion, are 30 days or longer. Anything longer than 30 days. All right. You want to use your day chart when you're doing this. Remember, 30 days or longer, you want to look at a day chart. Trend lines, break it. You want to get in when it's green. Okay. That's the strategy for it. I usually want to buy out of the money. So let's say we hit the 200-day moving average, and let's say this is a strike that's 3 months out. I want to go out of the money, and I want to go with the one with the most volume. Y'all see that? 51,000 versus 42. Now I know you're like, well, Joel, why don't you just pick the one that's 42? Because it's $520 versus $200. It's double the price. And because I'm giving myself time, remember, when you go out of the money, you make a higher return on your investment. I can still spend $520. Y'all see that? I can spend $400 and buy 2 contracts and still pay about the same amount of money as this one, is $425. I have a higher chance of it hitting because look, somebody knows something. And y'all know what ended up happening? We actually got higher, and we actually went higher than that strike price. Okay? This is old. Y'all saw the charts. Y'all saw what happened. This worked out. Shoot, these worked out, to be honest. And they knew that it was going to work out because the billionaires had been talking to all of their billionaire friends. And they was like, oh, we all buy an Apple. It's time to buy. We got to put this money to work. We're not in the business of putting money in a savings account. That's what thousandaires do. They worry about savings accounts. We're managing funds. We don't make money off of money being in our savings? We make money on Apple being up 100% in 6 months. Not a savings account that's making 3%. You're thinking like a thousandaire, not a billionaire that's managing your money. They managing your money. Okay? The pension funds, the mutual funds. All right. So outries. Outry is when you exit. I always tell people there's really no time to get out. You get out. All I care about is you managing that option or stock in the beginning. All right. Fiercely protect your capital. Soon as it goes into the profit, as long as your profit is higher than your risk, and if you don't know what your risk is beforehand, you shouldn't be buying it. If your option is $150, the first question I'm gonna ask you when you book a session with me, how much are you risking on that option? If you don't know the answer, that's the problem. I spent $150 on it. How much were you risking? I was risking the whole thing, Joel. All right, well then you probably wanted to make 100% or higher, or $150 or higher. And you're like, hold up, I have to make 100%? Yeah, that's how much you're risking. You're risking 100%, so your reward should be 100% or higher. Well, I didn't expect that. I just wanted to make $50. Well, then you have to risk $50. You can't do the opposite. You're not playing it in your favor by doing that. You don't risk $5,000 to make 50. What you gonna do when you lose 5,000? Because it's not if it's gonna happen, it's when it's going to happen. You're gonna lose, out of 10 trades, you're gonna lose 3 to 4 of them. I'm sorry. And I'm a great trader. I'm an excellent trader, and I lose 3 out of 10 trades. But when I lose small, because I lose $100. But when I win, I'm gonna make $500. That's the difference between me and you. Now, to give you guys a head start, here's a couple of companies that you can look for. E-commerce is what everybody's looking for right now. That's the number one thing. That's the number one thing. All right. Just Google e-commerce. Give me some e-commerce stocks. That's what I want to buy my options on. Then I want to look and see when they fall to the 200-day moving average. I want to put my trend line there. I want to buy them 60 to 90 days out. That means you have to be patient. You got to be patient. Stocks only really hit their 200-day moving averages once or twice a year. And when it happens, you got to jump on it. Look for web services, look for streaming, subscriptions, or industry leaders, okay? This is my list of companies that I own that I buy options on. They're called my stock stars, all right? So We're running low on time, so I'm gonna get through the other strategies, and then we're gonna put it all together when I do the charts with Joel at the end. Okay. So let's go through some. So let's talk about 1 to 30-day trades. It's the hardest to manage. Hardest. But y'all love doing it because it's the laziest way to do it. But if you're gonna do it, what chart do you look for? You should immediately say our chart. Ha ha, Joel told me that. 30 days or longer, day chart. 1 to 30 days, hour chart. That day, 1 minute chart. I already have that set in my brain. So if you're looking at a day chart trying to trade day to day, that's probably why you're losing. You're looking at too high of a time frame for a 3-day trade. You don't really know what's going on. A 3-day chart does not show me nothing. But if there's 24 hours in a day, now I have 70-something candles I'm looking at versus your 3. You looking at 3 candles trying to figure out how to trade something. I'm looking at 75. See the difference? Okay. Or not even 75, 25 if you want to use the hours of trading. Still 8 times, it's still way more, 8 times more than what you're looking at. The more candles I have to look at, the better chance I have to know what's going on. And 90% of y'all trade this way. And that's why 90% of y'all lose. And that's why 10% of us win. And we take 90% of y'all's money because you don't know what chart to look at. You're all over the place. You got 75 indicators trying to figure out why this and how to do that. Keep it simple. Keep it simple. But you also need to use the what would Joel do method of entry. What is that entry? Very easy. You're going to look for 3 moves. 1, 2, 3. 3 moves. 1, 2, 3. 3 moves. 1, 2, 3. You want to get in on the 3rd move. You want to get in on the 3rd move. You want to get on the 3rd move or the 3rd wave. Stocks stair step going up. Remember what I told y'all? Stocks trend in one direction 80% of the time. You want to buy a bullish stock that's trending up. How do you know if it's trending up? I'm going to give you an indicator. And once it starts to trend up on the 3rd move, you get in. You get in on the 3rd move. Well, why don't you get in here? Because you're not going to know about this move. That's the billionaires move. This is when the billionaires sell to the suckers. This is when the advanced traders get in. Suckers, billionaires, advanced traders. Who do you want to be? If you're not a billionaire and you don't want to be a sucker, then you want to get in when the advanced traders get in. Okay? Advanced traders, suckers, billionaires. Billionaires talk to each other. They know when the market's going to go up. You're not a billionaire yet. You're not going to get in on this move. Stop trying to do it. I see so many people, they spend their whole lives trying to get in on that move that's going to happen. All right? When all you got to do is wait for the move to happen and just get in on the 3rd. Well, I'm going to wait 10 years when I can just get in when the billionaires sell to the suckers and then it starts to go up in price. I don't have to wait 10 years for this to happen. Okay? You guys got to learn how to do that. And you want to put your stop right there. So when you see the 1st move, billionaires, 2nd move, suckers, 3rd move, advanced traders, you get in. If it starts to go back this way and it drops below the 2nd move, you know to get out. I'm going to risk this amount of money to win that much. Okay? All right. So a lot of what I'm showing you guys are this method of trading. You're going to find this in the 60-minute trading video. It's going to be a lot of what we talked about today, but it's going to really keen in on entries and exits for trading. I don't have enough time to show you guys all of that. All right. I gave you guys a lot of information today, like a lot of information in this 3 hours. All right. Exit and, entries and exits, risk to rewards, trading, learning what options are, you know what I'm saying? Different time frames, debit spreads. You learned a lot in 3 hours, the most you're ever going to get in 3 hours. All right. So there's other videos that reinforce some of the specific things that we talk about. But you also want to use the Ichimoku. Now, everything that I showed you guys today, you can pull up, you can download the Thinkorswim chart setup. You're going to be able to set up your charts with the Ichimoku, with the John Carter, with the 1 minute, the hour, and the day chart. It's going to take you about an hour to do it. Now, the Ichimoku, you're going to use on the 1 hour chart and the 1 minute chart. So that means you're going to use it for 1 to 30 day trades or in and out the same day. You're going to hear us talking about the Ichimoku in the Ninja Trading Room all the time. When the stock is above the Ichimoku, remember, we want 3 moves. 1, 2, 3. Billionaires, suckers, advanced traders. Billionaires, suckers, advanced traders. You get in when the advanced traders get in. When the advanced traders get in, if it breaks back down to this, you get out right there. 1, 2, 3. Let's say you get in way up here. 1, 2, 3. Billionaires, suckers, advanced traders. You get in somewhere there, your stop is right there. If it breaks back to your stop, great. You don't lose nothing. Well, that's not true. If you get in here, this is where you lose a little bit. If it starts to go your way, you're fiercely protecting your capital. You bring your stop back up, bam, you're out. You have to do that when you're trading 1 to 30 days or in and out the same day, because you got to be right. You got to be right or right out 1 to 30 days. Anything longer than 30 days, y'all don't need stops, because you're not even worried about that trade. You can go to sleep at night. You're not worried about it. You got 90 days. Not 1 to 30 day trades, and definitely not trades in and out the same day. You got to fiercely protect your capital. Okay. So on those swing trades, same thing. Let's say you see something going down. Well, let's not talk about the shorts. Let's talk about going up. It starts to go up in value. You see 1, 2, Joel gets in. 1, 2, Joel gets in. See there? Entry long. 1, 2, Joel gets in. I get in way up here. I know you're like, well, why didn't you get in here? Because you're thinking like you're not a billionaire. You don't know when this is going to turn. You didn't. How many people you think bought it right here at 352? Ain't no indicator out there going to tell you to buy it at 352. It ain't out there. Quit looking for it. It's not out there. What is out there is I know when they start buying. And when they start buying, I got a resistance way up here. It's probably going back to this price up here. So I still get it on sale. Does it matter if I buy it at 350? If you came up and you said, I got it for 352. And I said, well, I got it for 360. And then we said we both sold it for 372. You think anybody care less that you bought it here and I bought it here? If both of us profited all the way up here, start thinking like an advanced momentum trader. Okay. When I'm buying 1 to 30 days, guys, I'm buying at the money. At the money, at the money. Why? Because 1 to 30 day trading is the hardest. So I can't really go out the money because I don't have enough time for it to work out for me. And I don't want to go in the money because it costs too much. I want to buy it at the money because it's right at the price of the stock. And I can manage it for 1 to 30 days. Now, if it's less than 30 days, less than a day, I'm going to go out of the money. So before we even get to it, when do I buy at the money? When I'm buying 1 to 30 days. When am I buying out of the money? If I'm day trading or if I'm going 30 days or longer, I'm going to go out of the money, the one with the most volume. If I'm going 1 to 30 days, I'm going to buy at the money with the most volume, probably this one for 520. Okay. All right. So exits, we already covered the exits. When do you get out? As long as your reward equal to or greater than your risk, you can get out at any time. I'd rather you guys gamble on profit than gambling on losses. I hate seeing y'all gambling in losses. Take your little loss and then get into a better trade. That's what I teach. Take your loss, get into a better trade. Now, fast money intraday. Let's talk about this quickly. This is literally what I do in 60-minute trading. I don't want a lot of you guys doing this because if you have a 9-to-5 job, this is not for you. If you can't focus and look at a chart for at least 60 minutes, this is not for you. If you got to get up and take care of the kid or take your mother-in-law to the store and you're driving around and you can't look at that particular stuff, this is not for you. I'm sorry. It's only for your stock stars. Only your stock stars can trade intraday. And there's nothing wrong with that. You got to stay in your lane. Everyone with a 9-to-5, with 12 jobs can trade 30 days or longer. Anything less than 30 days, you gotta be able to look at charts, and you gotta be able to look at the stock or the options, at least 2, 3, 4 times a day. If you can't do that, this is not for you. This is not for you. Your options contracts just have to be 30 days or longer. And believe it or not, guys, that's where you're going to win the most. When you hear about traders that's made millions and millions of dollars in options, it's not because they're day trading. And it's also not because they're buying it 1 to 30 days. What they end up doing is they're buying options 6 months, 9 months out. And then that stock pops in the next 30 days. And then they take their profit and then get into another trade. They're giving themselves so much time for it to work out. It works out earlier. They take their profits and put it into something else that's bullish. All right. But if you're going to do what we're doing, you got to commit to what you're doing. All right. If you're going to scalp and you're going to get in and out the same day, you got to use the 1 minute chart. I know I have 5 minutes here. Look at the 1 minute chart. What else are you going to be looking for? Thinkorswim has a pre-screener called the percent gainers list. The percent gainers list is going to have stocks that are up today. That's what the billionaires are buying. The billionaires are buying. That's what I want to buy that day. I don't want to buy something that's down. Y'all do this all the time. It makes me so angry. You study Roku for 7 days. You decide I'm finally going to trade Roku, and look, it's on sale. It's off 8%. I'm going to buy an option on it and hope that I make money on it today. And then it goes down in value for the next 3, 4, 5 days. Because you're thinking like a thousandaire. You ain't thinking like a billionaire. If Roku is down 8% today, it's probably going to be down 5% tomorrow, maybe 3% the next day. Because when billionaires sell off something, it's usually like a 3-day sale. And then it'll go up in price for like the next 2 weeks. Then it'll sell off for 3 days because that's that stair-stepping pattern. Y'all get caught up in this. And then you'll buy this, and then by the expiration at the end of the week, because you can't afford the one that's 2 or 3 weeks out, because the options class that you took, they didn't teach you how to buy debit spreads. Pay thousands of dollars, and they ain't never tell you, I can buy that Roku option for cheap. Why didn't they teach me that? Joe showed me this in 3 minutes. All right, you better vet who's teaching y'all. All right, so what are you using? The what would Joe do method? 1, 2, 3. 1, 2, 3. All right. Still same motion. So when I'm day trading something, I gotta be fast. I gotta be a ninja trader. I gotta know when to get in, third wave. I gotta know where to put my stop. I gotta make sure that my profit is gonna be way greater than my risk. All right. So if I was trading Tesla goes up, down, up. I want to get in there, put my stop there. There you go. I want to buy an option right around, 9:45. I want to buy my option for that day. I want to get in and out the same exact day, but I only trade things that are up. I'm not going to trade something that's down trying to make money to the upside. You're using an investing strategy trying to trade because you're talking to too many investors that don't know how to trade. I know how to trade. Traders don't trade things in the opposite. It's like you see a train coming one way and you trying to reverse the train's movement. That don't even make any sense. And a lot of you guys trade that way. It makes no sense whatsoever. Y'all throw a Bollinger Band on here and try to short something that's going up on a day trade, on a stock that everybody else is buying because you want to be the black sheep and you want to go against the grain because that's what you think the percentages lie. That don't even make sense. All the billionaires are buying this and you want to go against it. You want to go against the billionaires. That makes no sense, which is why y'all lose money. Okay, but I want to buy out of the money strikes. When I'm day trading, I want to buy out of the money. It's going to be cheaper. It's going to give me a higher return on my investment. I want to have 1,000 contracts or more on everything that I'm buying. All right, exits are the same. We talked about this. Your reward has to be equal to or greater than your risk. Okay, so we're going to do charts. All right, it's 9 o'clock. I want to make sure that we cover everything. All right, so with charts with Joel, I'm going to go through you guys' stocks. All right, my niche, you guys should have put a list of stocks that you guys wanted me to look at. If not, I'll just look at whatever was hot today. We'll look at the Apples. We'll look at the, some of the hot stocks that are out there if you guys didn't create a list for me, and that's fine. But let's just go over the steps in buying options quickly. Step 1, You want to pick a bullish or bearish stock. You only pick a bearish stock if you're trying to short it or buy a put. You want to pick a chart with the correct time frame. Are you using a 1 minute chart getting in and out the same day? Are you using a 1 hour chart where you can hold that option overnight up to 30 days? Or are you trading 1 day or longer? I mean, you're using the day chart to trade 30 days or longer. If I'm trading 30 days or longer, I'm using the 200-day moving average. I'm not using the 200-day moving average, people, to day trade or even buy a 30-day trade. The 200-day is for 30 days or longer. You want to pick the strike with a lot of volume, preferably 1,000 contracts or more. Why? Because I need it to be liquid enough so that I can get out. And then I want to calculate my risk to reward. How much am I risking on this trade for my reward? Okay. How much am I risking? Now, again, if you guys need help outside of this, you can go download the old. I know some of you guys took this is an older options party. It's everything we talked about today. Now, if you download this video, you get to keep it forever. This video that I'm showing you guys today, you're only going to have 2 weeks access to it. 2 weeks, that's it, 14 days. I can't save every video for everybody. Y'all ain't paying me to store all my stuff with Zoom, all right? So 2 weeks, you have access to the video. You can watch it a gazillion times. I encourage you to do it, all right? Thinkorswim chart setup is how you make your charts look like mine. If all of this is over your head fundamental-wise by the basis of the market, you probably want to go try and watch Stock Party. And then probably download the advanced technicals again. We went over advanced technicals in like 15 or 20 minutes. I got a 2-hour video going over advanced technicals. If you just need help with, learning how to draw a trend line, knowing where that trend line goes. But by taking this particular class, it is a little bit more advanced, but you have all the tools at your fingertips that you can use. Now, again, it's 9 o'clock. So anybody that needs to leave, we're just going to go over a couple of scenarios. You guys got you guys got the meat of the webinar. I know a lot of you guys feel like it can't be really this easy. Joel, it can't be this easy. I see too many people losing. Well, I told you what to look for. Risk to reward, time frame. If you keep it to risk to reward, knowing what charts you're looking at, buying stocks that are bullish, you're going to do well in this particular game. All right. So let's look at a couple of these stocks, and then I'm going to let you guys get on out of here. So before we even get to that, I want to make sure that you guys understand that there's a couple of places that you can go to. If you haven't joined the Ninja Trading Room, just buying any product that you've ever bought from me, just buying any What Would Joel Do product. If you show me your receipt, and remember, I'm not doing this. My niece is helping me out with this. So she's going through everything. She don't know y'all. She don't know who I do consultations with. So you got to show a receipt. And once that receipt is seen, we'll allow you to go into the Ninja Trading Room. So if you got friends and family that's trying to get in, sorry, unless they can provide a receipt, they can't get in. Now they can buy a pass. You can buy a pass at the PayHip. To get into that Ninja Trading Room. The Ninja Trading Room is strictly for day traders trading that day. Don't go in there looking for investments. If you're looking for investments, you need to be in the Insider Trading Room. If you're looking for personal one-on-one consultations, you need to go to my What Would Joel Do page. All right, 3 places that you guys can go to. I have an app that's coming out next year. So for you guys that don't want to be involved with Facebook, you guys will still have access to all the information that we have. So I'll provide that to you guys. Just look out for it in the future. But let's go ahead and go to the charts. I see 6 stocks for us to look at. So we're going to look at it on 2 frames. So it's 9 o'clock right now. I can go until about 9:15, 9:20. All right. So let's say we wanted to trade a stock called Jumia. This is how I'm going to analyze it. So first things first, I type Jumia over here because first of all, I want to know how big Jumia is. Well, first of all, I need to know the ticker symbol for Jumia. So Jumia is the Amazon of Africa. Okay. So I'm going to look at its charts. Okay. Now we're going to look at it over all 3 time frames. So let's say I'm looking at Jumia. First things first, I need to know how big Jumia is. Jumia is a $3 billion stock. How did I know that? Because 1,000 millions is a billion. So Jumia can grow. That's why it's up 13%. The smaller a company is, the higher the beta is, you're going to see these types of gains. Beta is what I teach in Stock Party. The stock moves about $4 a day. That means if I'm day trading Jumia, I can make about $400 a contract if I'm right. But I got to know, first off, if I want to buy it. First things first, let's look for the 200-day moving average. That's the very first thing I always look for. Well, look at this, guys. We just talked about the 200-day. I know y'all didn't believe me when I told y'all that traders or billionaires love buying things at the 200-day. So many traders I know tried to catch the bottom because they thought it was going to reverse here. They thought it was going to reverse here. And they tried to buy something that was going down. And I said, why are y'all buying something that's going down? If you're buying something that's going down, that makes no sense. Money is coming out of it. Billionaires are selling it. Wait until billionaires start buying. Y'all see this volume? This went from no volume. No, first of all, it went from high volume in selling into big volume in buying. Wait until the billionaires start buying it. Why did they start buying it? It got close to the 200-day. It went down to the 200-day. It started to go up. It went green on the John Carter. 1, 2, 3. Bam. Joel said get in on the third move. So 1 move up, 2 moves, 3. Maybe Joel gets in somewhere around $8.26. All right. If you can't see that move, this is how it looks. Joel would have bought it. 1 move, 2 moves, 3 moves. Joel gets in on the third move. Billionaires, suckers, active traders. I would have got in somewhere between $8 and $8.66. I had 3 days to get in. But Joel, what happens if it dropped down here? Well, I would have sold it. This is my stop. My stop is always at the bottom of the second move. Hold on. Geez, I can't erase this. Guide. All right. So trying to make this bigger. All right, I got a lag going on. So let me just hit this plus. All right. So to make it look a little bit better, Jumia was going down in price. We finally broke the trend line. That means the trend's probably going to go up. Volume picked up. People started buying. The billionaires are buying. Joel's going to wait until he sees 3 green candles. Bam. Joel can buy now, but is Joel going to buy just because he sees 3 candles? No. Joel's going to see a move go up. That's the billionaires. You're never going to get in that move. Because even when the billionaires got in here, it was a fake out and went down, never came back up. Then it went down. We got to sell to the suckers. Once all the suckers sell, then the true traders start buying it right around here because this is the natural move of the market. You don't believe me? Look, stair steps. Look, stairs. Look, stairs. Did we ever come back to the 200-day? Nah, we went up halfway and then went higher. Okay. So you could have got in here at $8. How much money would you have made? Let's say you bought 30 days out. It's October the 5th. You could have bought an option that was November the 5th or December the 5th, where you're going to make $100 for every dollar move. So if this goes from $8.82 to $9.90, that's $100, $200, $300, $400, $500, $600, $700 you could have made. And I guarantee that option didn't cost that much. Okay. You could have bought that $8 strike. So let's say we were looking at the $8 strike from November. That $8 strike. I'm going to show y'all how much that option was. I don't even see $8 on here. That's crazy. That $8 strike. Y'all, it's gonna make you mad when you see how much that option was back in March. So back in March, oh, this option actually came out at this particular time. So anyway, this option went from about $600. Y'all see that? $600 to about $2,200. 600 $2,200. That was in like the last week. I don't know why it's not letting me see that option from February, but don't worry about it. Let's go back. Just know that you could have bought an option out of the money and you would have made a lot of money. You could have got in here. You could have waited for it to go up. It went down. Let's say you got in here. This is where y'all go wrong. I'm going to buy a 7-day option because we broke here and Joel told me to put my stop there. But if you gave yourself 30 days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10, it took 12 days to get back to even. But then 13, 14, 15, 16, 20 days out, you're making ridiculous money. Give yourself time if you're using the 200-day moving average. Well, let's say we wanted to trade this week to week. Well, the day chart's going to look different. The day chart's going to look different. The Ichimoku, you want to buy it when it's above the Ichimoku. See, when we broke below this Ichimoku on Tuesday, I know a lot of you guys who bought Jumia way back here. Well, you could have made money if you were shorting it, but if you wouldn't have bought it if we were underneath here. If you're trying to go 7 to 9 days out, you need to Ichimoku to tell you when it's bullish. It's bullish now. So let's say I wanted to buy it here. Monday, Tuesday, Wednesday, Thursday. This is why I tell y'all this is the hardest way to trade. All right. It went up. It went up and down, but you're talking about what just recently happened. As long as it's above the Ichimoku, 1 move, 2 moves, 3 moves, you can get in somewhere in here, the $34 range. And then you can make money by holding it overnight. All right. This is Thursday. Let's say you got in this morning and you wanted to hold it for a couple of days. You would have seen it go up, down. You would have said, dang, it finally got back above the Ichimoku on this third move. I want to get in right around 9:30, 10 o'clock. Well, if you notice, we're at the $36 range. So that would be the at the money. So at the money would have been $35. Out of the money would have been 38. 34 at, 38 out of the money. Well, watch this. Let's say we wanted to make money in the next couple of days. Let's say we wanted to make money next week. Anytime I see an option that's gonna expire on Friday, I usually go 7 to 10 days out. All right. I'm not gonna go Friday tomorrow. And I don't trade on the day that the options expire. So I'm gonna go to my products. Remember, we're gonna get in at around 9:30 at the 35 strike, but we want to pick the one that's at the money. So it looks like the only options that were available were the 18, which is fine. So we want to buy that option. We want to buy the 30. We want to buy the at the money strike. Now remember, at 9:30 this morning, the at the money strike was 34.35. So we probably would have bought the 34 or the 35 strike. How would I have known which one to buy? Would I have bought the 34 or the 35 strike? Well, I was going to buy it at the money. How did I know to buy the 530 or the 470? The volume. Aha. 4,500 versus 700. 45, 7. This has the most. This would have been the option that we bought. We would have bought this at 9:30. At 9:30 this morning. At 9:30 this morning. Let's see how much that option costs. At 9:30 this morning, this is Thursday. This is Thursday at 9:30. Well, this is an hour chart. So let's just say we bought it at 10 o'clock. At 10 o'clock, that option was, remember, multiply that times 100. That's $282. That option went from $282 to $450 in one day. One day. One day. You would have made 100% return just by using the tools that I'm showing you. You knew that it was above the Ichimoku, so you knew it was bullish. All right. You got in on the third move. You knew to get in at 9:30. It started to go up in value. You could have gotten out that day, or you can hold it. Now that you bought it at $280 or $200, you can put your stop at 280. So if you wake up tomorrow and it's below 280, you just need to sell it. Or you can hold it until that expiration date, which was, I don't remember what it was. Okay. All right, let's look at a different one, Target. Let's look at Target. First thing we want to look for is the 200-day moving average. The 200-day moving average. So if I want to look at it long term, when was the last time we hit the 200-day? Way back here. That's when you should have bought Target. You should have waited for it to hit the 200-day moving average. It hit it. It broke the trend line. And then you wanted to wait until you saw the John Carter give you how many candles? 3. 1, 2, 3. There's your 3 candles. I don't even need to calculate how much you would have made, because if you would have bought that option for $104, we're sitting at 172, people. 104 to 172. You would have won. Y'all see that? It never came back. Never came back to 104. Never. 30, 60, 90 days out, you would have made a killing. See that? Y'all see that? Even here, it hit the 200-day moving average. Let's say you missed that move. And you said, oh, God dang it, I missed the move. I was on vacation. Oh, it broke back down to the 200-day. And then it went green, 1, 2, 3. And then Joel said, get in on the third move. Oh my God, Joel is such a genius. 1, 2, 3. Look at that. I got in and it never came back to my price because Joel is the best. I didn't know y'all was gonna look at Target. I know price action. Look at that. 1, 2, 3. Could have got in. 1, 2, 3 is green. 1, 2, 3. 1, 2, 3 is green. Should have got in. That's on the day chart. You just winning. You winning if you're trading the way that I'm trading. Let's say you wanted to trade it on a day chart. Let's say you wanted to day trade Target this morning. Was Target bullish or bearish this morning? Well, let's look at Target. At 9:30 this morning, Target was bearish. How did I know that? Because at 9:30 this morning, the first color I see is red, 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 and we underneath the Ichimoku. Bam, I already knew by 9:33, I ain't trading Target today. Good night. Let me go look for another stop. And what did Target do? It went down. So no matter how, y'all see how a day chart showed you something different than a minute chart? Today, Target woke up and said, I don't want to trade. You could have got up and within 1 minute, you would have known, oh, not buying it. Yeah, let me go look for something else. But what do you guys do? I'm going to force this trade. I'm going to force this to go up in value on something that doesn't want to go up in value. Let's look at PayPal. Day chart, 200-day. I don't know that you guys are giving me these stocks, but I know how to trade. I will out trade any friend, family member, teacher you got that's out there. Because when we hit the 200-day moving average, Joel said, look here, teacher. Joel said when it hits the 200-day moving average and it's angled up, he said to look for 3 greens. And then when he sees 3 greens, he gonna get in. 1, 2, 3. Let's say you missed that move. Okay, you could have got in way up here because stocks stair step going up. They stair step. Let's say you was using the Fibonacci tool. I missed it. Joel said it drops 25 to 25%, went up, dropped close to 25%, started to go up in value, you get in. It's like magic. I know I make this look like magic, right? It's not that I make this look like magic. It's because I know how billionaires think. Stair steps, people, stair steps, 1, 2, 3. Let's say I wanted to trade it on an hour chart. Is it bullish? Nah, it's bearish. PayPal been bearish since Wednesday. I ain't buying PayPal. Get out of here. It's bearish underneath the Ichimoku. When it was above the Ichimoku, you could have bought it. If you want to buy stuff for 1 and 2, 3 days, use the Ichimoku. Look, it stayed above the Ichimoku from Wednesday to Wednesday. Then it said, let the suckers buy it for now. Wait for it to get above it. 1, 2, 3, get in. That's PayPal. Let's look at AVGO. AVGO. What's this? Broadcom. All right, let's look at AVGO on the 200 day. Same thing. Same thing. When do billionaires like to buy companies? When they touch the two. Why did this hit the 200 day like 12 times? Why? You think all of a sudden they started buying more of this at this price? Nah. Then it really sold off in March. Well, it sold off in March because of a pandemic. What are you looking for? Joel said, look for 3 candles that's green after after it hits the 200-day moving average. And sure enough, the candles went green, 1, 2, 3. Then Joel said, get in when it makes the 3rd move. 1, 2, 3. Bam, there you go. Billionaires, suckers, Joel gets in. That's why Joel makes money consistently all the time. Y'all see that? Look at that. Look at that. Joel wins. 1, 2, 3. Joel gets in. Let's say you wanted to buy it let's say you wanted to day trade it today. I've been looking at this company for 3 weeks. I'm gonna buy it today to the upside. Why? Oh, that's the 1 minute chart. Sorry. 1 hour chart. What is it doing? It's bearish. Well, it was bullish and then it started to sell off today. All right. It's bearish right now. You're not gonna find me buying this. The billionaires are selling. The billionaires are gonna sell this for 3 days. Then it might get above the Ichimoku, you can buy it. You missed out on the move. All that money your boy said he made, you gonna try to get in today. Look, all you had to do was wait for it to go up, down, Joel gets in. Up, down, Joel gets in, because it stair steps up. Every time it sells off, y'all be killing me. What's wrong with the stock? You the sucker, that's what it is. You're the sucker. Quit being the sucker and get in on the 3rd move. You can't be a sucker getting in on the 3rd move. Billionaire, sucker, that's where you get in. Billionaire, sucker, I get in. Billionaire, sucker, I get in. Billionaire, suckers, I get in. Stair step. It's the most common move you're going to see in the market. All right, let's look at Snap. We got 2 more and then we're out of here. Snapchat, 200-day moving average. How did we know to buy it? I bet you it hit the 200-day. I didn't know y'all was gonna pick these stocks. Joe must have had his niece go out and find all these stocks so that it can look like it worked every single time. Nah, it works every single time because this is how the billionaires think. Been telling y'all this for years. 200 days, it's like a broken record. You're like, how come every single chart did the same exact thing and there are 5 different stocks? And why didn't my educator teach me this? Because your educator ain't trading, that's why. You learning from somebody that's making money off of classes and not trading. Or they going off their opinion. I think you should buy Snapchat because I look at the price to earnings multiples, and looking at how much they can earn in the next 6 months should signify that this stock can grow this amount. Man, are the billionaires buying or are they selling? Is it near the 200-day moving average or not? 200-day went green. 1, 2, 3, get in. You missed that move? 1, 2, 3, get in. If all these moves look unfamiliar to you, if you're having problems finding the move, use the Fibonacci tool. Joe said that it's going to drop 25 to 50% of the move. So when it went up, what did y'all think it came down to? Perfectly, 25. Why? Because that's a real number. You can't go higher unless you pull back a certain number. It can't pull back 100% because then that's a sideways move. A lot of you guys' strategies is looking at where this is and then trying to get in again when it hits there. And then you wondering why you can't make money. Because you got a sideways moving strategy trying to trade off a momentum stock. Because you listening to investors and not listening to traders. Okay? So I'm sorry that I'm bad mouthing your teachers, but a lot of them suck. They don't know how to trade. All right? 1, 2, 3. Here, green, up. Snapchat. You wanted to day trade it? It's the same thing. Did it wake up wanting to make money today, or did it wake up not wanting to make money? You can't force like if you go out and you see that the ocean is moving waves to the left, y'all swear y'all can move the waves to the right. A lot of y'all just swear y'all can do that. Nah, you can't. If the billionaires are buying Snapchat this morning and it goes up in value and it's above this Ichimoku and it's the third move, you might want to get in this trade. You could have missed that one. You could have got in on this one. And you would have made a killing. Look at all that money you would have made today. Y'all make trading hard. I make trading easy because I just find out what the billionaires are doing and I follow them because I'm smarter than them. I don't have more money than them, but I'm smarter. Buy what they're buying. Don't buy something day trading if the stock is down. If the stock is down, billionaires are selling it. You don't do buy low, sell high on a momentum stock. That's an investing strategy, not a trading strategy. If I got in at 9:30, y'all want to know how much money you could have made on Snap? I'm about to make all y'all mad. At 9:40, you could have bought this stock. So at 9:45, let's say we bought an at the money strike or a little bit out of the money. Let's say we bought this $50 strike. All right. So you go here. You look at the one with the most volume. At that time, we were at 50, but the most volume was way out here at the 53 strike. We never even had to get to 53 for you to make money. You could have woke up this morning not even know that you was going to trade Snap. You could have said, well, dang, I didn't even know I was going to trade Snap today, but I see that it's up and I see that it's on its third wave. And Joel said, get in on the third wave and it's 9:45. Well, you could have bought that stock at 9:45 and it's about to make y'all angry. You could have bought that strike for 14 cents, $14. Everybody here has $14. That $14 was worth $38. Let's say you spent $1,400. You could have spent $1,400 today just because the billionaires decided that they wanted to buy Snap this morning. You would have said, well, dang, I think the billionaires, I forgot billionaires buy for hours. I see their move. I see the sucker move. Joel said get in on that third move, the one with the most volume, because somebody knows something that y'all don't know, because that's why they're billionaires. You could have made a $140 investment that would have been worth $380 in roughly about an hour and a half. That's 60-minute trading. You know my 60-minute trading video? This is what I teach. And it went straight up, never came back. And you're like, how do people make this type of, how do they know what to pick? Because they went over here, they looked at their personal list. They looked up and saw that Snapchat was up and said, oh, the billionaires are buying. But you know what y'all do? Ooh, Google's on, Moderna's on sale, the vaccine coming out. Let's buy that option for 2 days. They're selling that today. They're not thinking about that. They're buying Twitter, Snapchat, and Peloton today. So you need to make money on Peloton, Snap, CrowdStrike, or Twitter. All right, last one, Snow. I think Snow is on this list too. Let's see what Snow did. Snow is right here. Last one, I'm gonna get on out of here. Snow didn't really wake up this morning trying to trade. Let's say we wanted to day trade Snow this morning. What chart are we gonna look at? The 1 minute chart. So we're gonna look at the 1 minute chart. We're gonna look at Snow. First things first, are the billionaires buying it or are they selling it? Well, at 9:30 this morning, it was underneath it. Look at this, guys. It's like, I can't believe it's right every single freaking time Joel shows it. Look, it went up. Billionaires, suckers. That's when I get in, right around 9:38. I would have bought this stock for $368. I didn't know that they was buying it this morning. I just woke up and I saw that it was up. It's a hot stock. I would have saw the 368. I didn't care. I didn't try to pick what strike it's going to go to. I would have picked whatever strike had the most volume. So at 9:38, I would have bought maybe the 370 strike. So we're going to look over here. I'm going to look for the 370 strike. At that time, it didn't have the most volume. This had the most volume. Shoot, this had the most volume. Snow never even reached 400 today, people, but I'm going to show you something. 10,000. I would have bought that strike right there for a day trade. Remember, I got in at 938. It never even reached 400 today. Never even reached it. Watch this. Watch this. It's going to make y'all mad. It's going to make you so mad. At 930, I would have bought that option. Never even reached 400. Never even reached it. At 938. 938. This is where you get mad. Never even reached it. Never had to wait until the expiration date. I would have got in. I would have spent $264. That option went all the way up to $700, people. You would have spent $250. You would have made triple your money. You would have made $500 today. And you didn't even know you was going to make it. And all you did was look for something that was up. Then you looked and see which volume all the billionaires are buying. And then you just bought it. And then you fiercely protected your capital. Let's say you got in here, because we don't talk about the losses. I'm sorry, I couldn't show y'all losses because most of the time, the way that I trade, you're going to win 75, 80% of the time. Let's say you bought this for 200, 300. Let's say you were only willing to lose $100. Well, when this went, if this ever dropped from 300 to 200, you got to sell it. You got to sell it. Maybe you're risking $200. Maybe if you got in at 300 and it dropped to 100, you would have sold it. Now, a lot of you guys would have said, well, it came back to the same price you bought it, Joel. That's why I teach y'all 60-minute trading. And I only got one more minute. I teach y'all 60-minute trading because I believe that when you're day trading, you should only be in a trade for 60 minutes, and that's about it. If I had gotten in this trade from 9:30, look at what price it was by like 10:30. I would have been able to capitalize all of this before it started to sell off. Because what goes up, I'm gonna take profit. You just made 3 times your money and you still gonna try to hold it for 5 days. That's how a rookie thinks. You never made a 300% return in your life. You just made it for the first time in an hour and you still trying to hold it for 3, 4, 5 days. If you're going to hold something like this for 3 or 4 days, if I bought 10 contracts, sell half of it. Take what I invested in it, then you can let the rest run to the end of the week because I'm playing with profit. That's what separates true advanced traders from rookies. All right, so I want to thank everybody for coming out tonight. Got to get on out of here, but I want you to answer one more question for me.